Am I audible and visible? Just 2 minutes. Let others also join. 2 minutes to 7:30. We will start. We are going to start with dividends, leverages. All are small areas, but coming for 4 to 6 marks in exam. So first I will cover dividends, leverages, and I will start with working capital estimates. Okay, dividends, leverages, working capital. Actually, cost of capital I wanted to start, but let's make a small change because let's complete those chapters which are small in content, but compulsory marks of 5-6 marks will come in exam. So let's start. Let us start. So very good morning, everyone. So today we are going to start with a marathon on concept cum workout session with regard to the subject paper number 6A, financial management at CA interlevel. This particular session will be extremely useful for those who are going for the immediate examination September 25. In this particular session, I am going to divide it into two parts, day 1 and day 2, or even if required, I will take another 1 day extra, not at all a problem for me. So there we are going to cover up some important concepts which will surely give you 30 marks in exam. So I am going to cover 30 marks in this marathon. Means paper will come for 50, 30 marks I will cover in this marathon. Clear? Because it is impractical to say that I will cover entire 100 marks, I mean entire 50 marks, but 30 marks surely will come if you listen to the marathon. Remaining 20, just you do your exercise, you do your work, you will get that extra 10-15 marks. You will get a thumping success in the FM paper. Okay. In this, I will also touch capital budgeting. I will also touch what? Capital budgeting. What I may not touch in this area is ratios. Because ratios, if you see in my regular batch, I will be taking somewhere around 14-15 classes ratios, because ratios is one of the most important chapter in FM. But ratios chapter you can discuss in two ways. Understand the formula and do problems on your own, that I will do. Okay, formula discussion I will do. But when you go into the concept now, 15 videos I have done totally in my regular session to make the student an expert in that field called as ratios, because ratios is one of the crucial area in real-time practice. Clear? So therefore, ratios chapter will be around 15 to 16 classes. Means around somewhere around 45 hours I spent on ratios. 45 hours content I can't summarize and tell just in half an hour or 1 hour. It takes time. Therefore, I will not insult the subject at any cost. Maybe law, maybe FM, just by discussing some summary of that concept. Ratios can be understood in two ways. I will explain complete formula. What is the formula? How we need to do the question. But actually putting pen on a paper and doing that will take a lot of time, which I can't do, to be very frank. So it will take time. So what I will do is, I will be covering out the chapters, number 1, where working will be less and marks are more. Those chapters I will be doing. Dividends we will do, leverages we will do, cost of capital, capital budgeting, capital structure theories, working capital. Understood the point clearly? And this time, a dedicated theory discussion also I am going to do. Okay? Because theory is coming for somewhere around 6 marks in exam. Dedicated theory discussion also I will put. Okay? Somewhere in the August 9th or 10th like that, I will put that particular video. Theory discussion on financial management. Clear everyone? Are you clear everyone? Some are asking for a volume increase. My volume is low. Some are asking for increase in the volume. My volume is low now. Actually, I don't know now. That's why I'm not listening. Manageable, right? Can you manage? Can I begin? Because again, checking it audio waste my time here. That's why. Shall I begin? Okay. So let us start. Everyone first open the pen and paper and calculator. Don't just see the screen when I am discussing about a concept. You have to do. It's a workout batch type. So we have to do sample questions from the study material only. Study material is more than enough for the examination. Okay. Do it properly. Illustrations and study material, book back questions and study material. These are the two things you have to do in order to make yourself perfect with the chapter, perfect with the subject financial management at interlevel. Okay. See, let us understand one point first. Name of the chapter we are going to start is dividends. 5 marks to 6 marks. 5 marks to 6 marks in exam. Let me first bifurcate the chapter. This chapter will be having, this particular chapter will be having 3 concepts. Number 1, first, dividend relevant concept, dividend irrelevant concept, miscellaneous concepts. From this, one question will come in examination. Dividend relevant concept, Walter, Gordon will come. Dividend irrelevance concept, Modigliani-Miller. Modigliani-Miller. Miscellaneous, bonus shares, buyback, stock split will come into this category. Okay. I repeat. Dividend relevance theories, Walter Gordon. Dividend irrelevant theory, Modigliani-Miller. Miscellaneous, bonus issue, buyback, stock split, and Linter's model. Okay, Linter's model. These are all the 3 categories of discussion that we are going to make in this particular area. So there are 3 kinds of theories: dividend relevant, dividend irrelevant, and miscellaneous. Okay, listen. Let me first show you certain things in the study material directly. Please I want you to see this. See, share repurchases is also called as buyback. It is there in your syllabus. Okay, it is there in your syllabus. Share buyback is there. Bonus shares is also there in your syllabus. Okay, also called as a stock dividend. Then starts the concept of growth. Growth anyway we will see in Gardner model directly. This is all about the theory. Linter's model is there. Linter's model. Next, dividend irrelevance theory, Modigliani-Miller. This is all about the MM approach. Walter. Gordon. Dividend discount model. Stock splits. Okay, these are all the concepts. After that, miscellaneous illustrations will begin. Then come chapter completed. So did you at least recognize that whatever I have written here is there in your syllabus? Everyone, did you at least acknowledge that these are all the concepts are there in your syllabus? Okay. First, to understand the idea behind this particular concept, first let us understand one point. I wanted to know one thing from the students first. Listen carefully to what I said. Have you ever done problems on bonus issue, buyback? Have you done any question on bonus issue and buyback? Problems. Theoretical discussion of bonus issue we made in law. I am not denying that. Those who are saying yes, what sort of problems you have done in bonus, not accounts? I'm talking about FM. FM la where you have done buyback question. Everyone, reply fast. I have given a basic example in my class. Problem did not do. Okay. FM book back, buyback problem is there. Where is buyback question? Oh, this one you are talking about, 9th one. No, not this. So first point number one, everyone listen carefully. What you did not do till now, we are going to do that today. So buyback, not from the capital structure chapter, that is different. Capital structure chapter buyback is all about conversion of a levered firm into unlevered or unlevered firm into levered. That's a different concept altogether. Okay, that is different concept altogether. In this chapter, 9th question is there in the study material. That is a nonsense question. Yeah, that is not the way in which you need to understand buyback. So today in this session, we are going to do a in-depth analysis also on buyback because FM paper is becoming difficult attempt after attempt. They are not giving it in a normal way. They are literally screwing the brain of the student when they come to exam hall. Therefore, I will be doing three types of questions, 4 questions. Okay, not 1, not 2, not 3, 4. 2 questions on buyback let us do, 2 questions on bonus issue also let us do, such that you will have a full clarity on how the bonus question has to be tackled in exam, how the buyback has to be tackled in the examination. Are you all with me? Shall we begin? I'm talking to you, everyone. Yeah. So our target is today we are going to explore a different dimension where no CA inter student in financial management will do it. Okay. And for those who think that dividends chapter formulas are there, those formulas don't have a logic. Okay. They have complete logic with them. Each and every formula in the dividends chapter will have a logic. Only a fool will not understand the logic inside the formula. I think you are all wise people. So think with an amount of wisdom. No formula will come just like that. Only a fool will think concept doesn't have a formula, formula has no logic. Just like that, we need to put a fool only will argue like that. We are not fools. We should understand clearly what the formula is, why it came. Bonus issue means what is bonus issue, what are the impact of bonus issue, how the bonus issue is made, what is the wealth impact of bonus, buyback, why companies go for buyback, if buyback is not went, what will happen, and buyback impact, everything we are going to discuss in the class today. Are you all with me? So, first thing, understand, FM is not such a subject where we will remember some formula, get into the class, do some problems and complete. A fool only will do like that. Okay. So first thing, have a clean slate of mind. Understand the concepts of FM in a proper way, because you are going to continue this in final level. So be very, very careful. Keep away from the nonsense in FM. Be yourself in touch with the concept, understanding and analysis. Okay. So nonsense ki be very, 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 very far. Or else how come we can generate students getting 94, 95 in AFM final level? So please, FM, no jokes here, because it will continue in final, also continue in your life thereafter if you go into investment banking. Sorry, I will just say one point and start with the concept. Recently, I had a talk with a ranker, R9, who got 94, 95 marks in AFM. That person said, because of your class and AFM paper, I have a love towards investment banking. I'm trying to do CFA, what I am doing, and I have done with level 1 and level 2. So he is now going into that. That's the love Kaushal Mukesh can create once you read the subject properly. FM, make it as a dearest subject for you. It will earn money. Crores and crores of money people are making on investment banking by understanding FM in a proper way. So CA finally is a game changer for you. For that, inter should be game changing first. You should understand the concepts of FM properly. Then these are parceled and taken to CA inter final level. Here itself, you don't know the concept. Dividends chapter is one of the finest chapters in your syllabus, where you can understand so many things. This itself, if you don't do properly, now where you will get interested final level? Formula, answer. You will not find anything great there. Are you understanding, everyone? That's why regular classes like will be taking 170, 180 hours means it's a worth learning. Here I will be doing the problems for you to crack the examination. Are you clear? Everyone? Okay, let's begin. See here. Now let us move on to the point. First one, Walter model. This is a dividend relevant concept. Walter model says like, see, I will first explain the entire concept in less than 5 minutes. Less than 5 minutes. I will explain the entire concept of Walter in less than 5 minutes. And then I will start doing the problems. You will also do along with me. Okay, let's see. Walter model says P equal to, P means P naught, price of a share. Share price is equal to D plus R by KE into E minus D whole divided by KE. Walter said only one point. What is this? Price. What is this? Formula for price. Okay. So share price will be calculated through this formula. Okay. In this formula, D is there or not? Yes. Therefore, dividend is relevant for pricing a share. Argument number 1. Everybody answer, understood the point clearly or not? Okay. So simple logic. Whether formula has a D in it, yes, that's all. Dividend is relevant for decision making. That means share price is influenced by the dividends. Is the first conclusion he wanted to pass. Next, after this. Next one. Let us now understand the formula clearly. Please listen. Price is influenced by two factors. D by KE, R by KE into E minus D whole divided by KE. D by KE. See, I don't want to go into the entire history like a regular class were explained for 1.5 hours. In 1 minute, I will explain. See, D by KE, there is a concept called as present value of perpetual cash flows. What do you mean by perpetual? Never ending. It will go like that till perpetuity. See, whenever you issue debentures, debentures has a life. Therefore, what we will do, after a particular period of time, interest will stop coming. Preference shares has a life. So after the period, dividends will stop coming. But equity share will be there till the company is there. Why? Clear answer. Private company, public company, definition in Companies Act says like this. Private company. Private company means a company which is having minimum paid up share capital. Public company means a company other than a private company having minimum paid up share capital. Means to have a company, private or public, minimum capital is required. So share capital is required. So equity share capital is required. So equity shares will be there till the company is there. So equity shares will be there till the company is there. So equity dividend also will come till the company is there. So therefore, perpetual dividends is the assumption of this entire model, not this model. Any equity share pricing model will always consider dividends as perpetual cash flows because share will be there till the company and share will give dividend which it will be there till the end of the company. Up to here, everyone understood the point clearly or not? Answer? Okay. So first point completed. So this has a formula. Present value of perpetual cash flows equal to present value of perpetual cash flows equal to I will get dividend till perpetuity. But I want a present value for that because we are going to value the share today. I want everything in today's terms. So present value of perpetual cash flows equal to cash flows per annum divided by R. R represents a required return. Debentures required return is KD. Debentures required return is KD. Preference required return is KP. Equity required return is KE. Okay. So therefore, cash flow. What is the cash flow share is giving per annum? Dividend. What is the required return on equity? KE. That's how the first formula came. Everyone understood the point clearly or not? Everyone. Fast. From now 1.5 hours, we have to complete this entire chapter discussion with problems. So I need your support. Everyone understood to here? Next. See here. This I have to explain now. Why I am explaining? Some people are thinking the dividends chapter formula don't have any logic. Just like that we need to put. Fool only will think like that. Let's not think like a fool. Let's understand the formula and its derivation properly such that you will be doing on your own itself. I wanted to make you self-sufficient, not dependent on anyone. So a fool only will think that these particular formulas don't have a meaning or a logic. These formulas do have a logic. These formulas do have a meaning. Understand in a right way, you will become the ranker. See, let us decode this formula now. R by KE into E minus D whole divided by KE. This is a formula, correct? See, again 2 minutes, I will explain the entire concept. See here, but understand I can't repeat like a regular class. There is a company. Their earnings are 10 rupee. Dividends are 4 rupee. Retained earnings are 6 rupee. Okay, retained earnings are 6 rupee. Retained earnings is nothing but E minus D. So that's the formula here first. E minus D. Okay. Now, I have 10 rupee with me. I have paid dividend of 4 rupee. I retained 6 rupee. What I will do with 6 rupee? I will put it in dustbin. I will reinvest. Reinvest at what rate? I will reinvest this 6 at R rate. Okay, for infinite period means I will invest and I will forget about it. Returns only will be coming. Principal I will not touch again. I repeat again. 10 rupee is the earning. 4 rupee dividend paid. 6 rupee retained with me. This 6 rupee principal I will put it in a bank account. Say for example, how many years? Perpetual number of years I will put it in a bank account. Clear? Giving me 20% return or giving me 10% return. Giving me how much return? 10% return. See, this 6 rupee will give me 10% return. Means what? Or let us say 20% return I invested. So 6 into 20% means how much? 1.2 I will get. Clear? This 1 point I will not eat. Okay? Like that I will reinvest this 1 point. See, I will get retained earnings of 6. I will reinvest every year 1.2, 1.2, 1.2, 1.2, 1.2, 1.2 like that. It will come forever. Okay? Tell me. First, year 1, earnings 10 rupee, dividend 4 rupee, retained earnings 6 rupee. What I will do with this 6 rupee? Invested 10%. Invested 20%. What is this? R. What is this? R. Okay. I will invest this at R rate. This is year 1. Okay. 20% I invest. This 20% will be giving a 1.2 rupee return or not? How many years? Perpetual years. So this will give 1.2, 1.2, 1.2, 1.2, so on till infinity. It will give 1.2. Now this will be coming from the next year onwards. So I want present value of this 1.2. Present value of 1.2 is 1.2 divided by KE. Why? Cash flow per annum 1.2 divided by KE. Correct? D by cash flow per annum divided by R, KE. So what is this 1.2? This 1.2 is nothing but 6 into 20% divided by KE. What is 6? E minus D. What is 20%? R. What is this? KE. That's it. That's how this numerator formula has come. So the first point, everyone understood the meaning of the formula or not? Everyone? Clear? I will explain one last time. Okay? I will explain one last time. I can't sit and explain for 1 hour like in regular session the meaning of this formula, but I will fastly explain the concept. Did you all understand or not? The basic discussion what we have made. This is a workout session or a marathon session. I will be very fast, not in regular session, but still I am trying to cover as much as possible. Okay, so let us decode the formula one last time. D by KE, R by KE into E minus D whole divided by KE. Okay, now what will happen? D by KE means present value of perpetual dividends. Okay, cash flow per annum is a D, R equal to KE. Here R is not the formula R, not this R. Here R represents required rate of return, KE. So D by KE is the first part of the formula. Clarity, 1 point over. Okay. Year 1, earnings 10 rupee, dividend 4 rupee, E minus D is 6 rupee. What I will do with this 6 rupee? Invest at R rate. Invest at what rate? R rate. Okay. This 6 rupee will give me R return. Means 20%, which is 1.2, 1.2, 1.2, 1.2, 1.2, 1.2, like that. From the second year till infinity, it will give. What is the present value? Present value is cash flow per annum. What is the cash flow per annum? 6 into R. In this R, if you put 20%, it will become 1.2. If you put 10%, it will become 0.6 divided by KE. Divided by KE. So what is this 6? E into E minus D into R divided by KE. This is the second part of the formula. Okay. See. R into E minus D whole divided by KE. Sorry. I will do this way. R into E minus D whole divided by KE. Sir, but denominator again KE is there. For that only I am coming. So this all happened for year 1. Like this for year 1, it happens till infinity, na? Therefore, this situation will happen again every year. That's why whole divided by KE. That's how this formula came. Everybody, shall we now continue into the next part? As I said already, those in live will listen to the concept. Okay. So don't expect me to put all after that. The discipline must be there. Stay online, complete the concepts. Next, next, next concept, dividend decision using Walter model. Sir, already we have done that? No, we have calculated the share price using Walter model. We did not do the dividend decision. So Walter said this way, situation, decision. He said three things. R greater than KE, R equal to KE, R less than KE. Three situations can come. R means rate of return or return on investment. I can't repeat n number of times. I told you this is 10th time I'm repeating that. Listen carefully for the first time. R represents return on investment. KE represents cost of capital. Cost of capital, also called as capitalization rate. Also called as capitalization rate. R can be called as rate of return, return on investment, return on equity. Return on equity. Okay. See, I will raise funds from public. Okay, I have to pay something to them for that. That's the cost. After raising the fund, I will put my fund somewhere or not. Where I am putting, that will give me some return. That's called as R. Means the taking rate, okay, the taking rate is more than, the taking rate is more than the investment rate, or the investment rate is more than the taking rate, or both are equal. These are the three situations you wanted to consider. Let us see the first one. I took money from public at 16%. At how much? 16%. That's KE. I can invest at 20%. I can invest at 20%. Means I took 100 rupees. I have to give back 116 after 1 year. I will invest somewhere. This 100 will become 120 there. So, see here. I took money from you. You are expecting 16. And after 1 year, you are expecting your 100 to become how much? 116. Second part. I am investing 100 rupees. I am investing 100 rupees. That 100 is invested at 20% rate. Means that 100 will become how much after 1 year? 120. Tell me. I have to, if I give to shareholders, shareholders are expecting 100 to become 116. Okay, next. If it is in my hand, 100 will become 120 after 1 year. In whose hands wealth is getting maximized? In the hands of company. Therefore, 100% retention means no dividend, also called as zero payout. Second situation, indifference point, means what? Whether you declare a dividend, whether you do not declare dividend, that doesn't make any difference. Okay, I will prove that also. Wait. Last one, R less than KE. What do you mean by that? I raised a fund at 16%, but when I try to invest, I can invest only at 12% rate. So 100 becomes 112 in your hands. 100 is expected to become 116 in the shareholders' hands. Therefore, you could not give what they expected. Give back money to them. Therefore, 0% retention, 100% payout is the policy. Understood this discussion up to here, everyone? Everybody answer. Understood up to here? Okay. Next. So situation, decision. We understood this. So R greater than KE, R equal to KE, R less than KE. So we understood there are three situations in this case. Final. Sir, how can you tell that R equal to KE has no impact on dividend? See, formula is like this. P naught equal to D plus R by KE into E minus D whole divided by KE. Correct? Okay. What we said, R is equal to KE. R is equal to KE means R 10, KE 10, 10, 10 cancel, 1 will be there. So P naught or P equal to D plus E minus D whole divided by KE, minus D plus D cancel, P equal to E by KE, formula dividend is not there, therefore dividend doesn't make any impact on share pricing. Up to here, everyone understood point clearly or not? Everyone answer. Up to here, are you all clear? So next, so as per Walter, this is the thing. Final touch. See, in exam, what they will do? They will give a scenario. They will give a scenario. Company profit will be given. You have to calculate D. We have to calculate that E. Everything we have to calculate. So D represents DPS, dividend per share, not total dividend. In the formula, D represents dividend per share. E represents earnings per share. It's not total earning. So divided by number of shares, we will get the dividends and earnings. Very good. Now DPS, EPS, we will calculate. Okay. Normally, they will give in the question like this. They will give R, some number. Let us say 20. KE 16. Actually, what we have to do, since R is greater than KE, wealth is maximized more in the hands of company. So retain with the company, don't pay dividend. Okay, that's the actual thing Walter said. But in the question, what they will do, they will give that company is paying some dividend in this case. Therefore, when you put the numbers in the formula, you will not get optimum share price. You will not get optimum is the maximum. When maximum share price can be achieved, if you do the dividend policy as what Walter said, R greater than KE, 0% dividend, 100% retention. R less than KE, 0% retention, 100% payout. If you follow this policy properly and put the numbers in that formula, price will be maximized. So if you do not do as per Walter, price will not be maximized. How it will happen? We are going to see through the questions and answers. Shall we start doing the questions on Walter model? Let us do 4 questions. 4 different types of questions let us do. Shall we begin? Shall we begin? Okay. Now listen. My discussion not yet completed. 2 points are there. Those 2 points also I will discuss and then we will start doing the questions. See. KE can be calculated. KE can be calculated in different ways. KE can be calculated in different ways. See. Earnings model, dividend model. With growth, without growth. With growth, without growth. See. KE with growth through earnings. E by KE. Without, sorry. KE with growth. Okay, this is how they will do. This itself will be called as a garden model. With growth. Without growth, E by KE. With growth, D1 by KE minus G. Similar. Next, without growth, D by KE. Without growth, D by KE. So what we have to understand, without growth, earnings model E by KE, dividends model D by KE. Correct? See, I will tell you this way. P equal to E by KE. Earnings model without growth. P equal to E by KE. Correct? Okay. Now, I will ask you one thing. Listen carefully first. Okay. Shall we? Okay. Now see. P equal to E by KE. P equal to E by KE. I will interchange, crisscross this. KE equal to E by P. KE equal to E by P. Or I can write like this. 1 by E by P equal to 1 by KE. Correct? 1 by E by P equal to 1 by KE. In simple language, if I have to tell the concept, see here. KE equal to E by P. KE equal to E by P. Okay. 1 by KE equal to P by E. Do you agree with this or not, everyone? 1 by KE means 1 by E by P. Okay. So 1 by 1 into P by E, that equal to P by E. That's how this came. Do you all agree with this or not? Waiting for your answer. Do you all agree with this? Understood? So, remember, KE will be E by P. Okay? KE will be E by P. P by E equal to 1 by KE. P by E equal to 1 by KE. Or KE equal to 1 by P by E. Okay, KE equal to, instead of writing E by P, I can also write it as 1 by P by E. So that's why two formulae we have to remember. PE equal to 1 by KE. KE equal to 1 by PE. P by E we will write as a PE ratio. So remember these two formula first. PE equal to 1 by KE means KE is given in the question, they asked you to calculate PE. This is how we should do. PE they have given, KE they didn't give. Like this we can calculate. These are the two ways of calculating PE ratio as well as the KE value. Up to here if you understand, let us start doing the questions and answers. Shall we begin? Shall we begin? Please come to Walter model, study material. See. Four questions I promise you na. Let us start doing the questions. See here. XYZ Limited, everyone take calculator, put it. Okay. XYZ Limited earns rupees 10 per share. Capitalization rate KE, return on investment R are 10 and 12. So R equal to 12%, KE equal to 10%. Tell me, this is a R greater than KE or less than KE? Greater, lesser, fast. Waiting for your answer. R greater, lesser. So R is greater than KE. When R is greater than KE, what is our policy? When R is greater than KE, what is our policy? See, everyone fastly reply in the YouTube. Reply in the comments box. Make it more interactive. Reply. Don't sit idle. Exams are very near here. Do it properly faster. Tell me, what is our policy? If R is greater than KE, full retention, full dividend. Yeah, perfect. Full retention. So 0% payout, full retention. Very good. So therefore, see here, determine the optimum dividend payout ratio. Okay, first answer. Optimum dividend payout ratio is no dividend payout. Okay, and the price of the share at that payout. Tell me. Let's calculate. Take the calculator. Do it. Illustration 1. P equal to, example, write the formula also. Here we can do directly. See, earning is how much? 10 rupee. Earning is how much? 10 rupee. Okay. Since we don't pay any dividend, D has no relevance. 0 plus E minus D. 10 minus 0. R plus, D plus R by KE into E minus D. What is the R? 12. 0.12, 0.10 whole divided by 0.10. P equal to, calculate 10 into 0.12 divided by 0.1. 12 divided by 0.1, P equal to 120 rupees. P equal to 120 rupees. What is 120? Optimum price. Optimum price. Why we get, I will ask a question, try to answer. 120 is the optimum price. I wanted to ask a question. You try to put the answer in the comments box. Why we got optimum price? Reply with the reasoning. Why we got an optimum price? Why we got an optimum price? Yes, one person has given right answer, Yogeshwaran. It's not dividend paid, not paid. We followed dividend policy as per Walter. Because we followed which policy? No, no. Don't give answer dividend not paid like that. Because we followed Walter policy. So the reason because we did not pay dividend, not pay dividend retention is not the point. We followed Walter policy. Therefore, when you put the numbers in Walter formula, you will get an optimum price. Understood the point or not? So the reason is we followed the Walter dividend policy. Like that, you have to present the answer in exam. Okay. Next. Is there any other question? No. So therefore, 0 dividend, 120 price. Everybody understood the concept clearly? Shall we go to the next one? Okay. Next. Let us do this question. Illustration 3. Keep the heading. Keep the heading in your notes. Illustration 3. Net profit 30 lakh. Outstanding 12% preference shares 100 lakhs. Number of equity shares 3 lakh. Return on investment 20% or KE is 16%. First, everyone tell me, calculate, see what they are asking. Calculate approximate dividend payout ratio so as to keep the share price at 42. In this, share price we need to calculate already given 42 rupees. Taking 42, we have to calculate the missing figure called as a dividend. Calculate the missing figure called as what? Dividend. So, net profit 30 lakh. Outstanding preference shares 12%, 100 lakhs. Number of equity shares, return on investment, this was given. In order to do this question, first we need to know, okay, in order to do this particular question, first we need to know what is the, okay, what is the net profit after paying the preference dividend. Okay, let's do. So net profit, write down. That is step number 1. Net profit 30 lakh. Preference dividend 100 into 12%, 12 lakh. Do it, do it. You need not do dividend chapter one more time after this session. So net profit minus preference dividend. Net profit to the equity shareholders 18 lakh. Number of shares 3 lakh. EPS 6 rupee. Number 2. Dividend calculation using Walter formula. Write down. P equal to D plus R by KE into E minus D whole divided by KE. Price given already 42. D we don't know. R we know already 20 and 16. Write in points always. Okay. E minus D. E we know 6 minus D whole divided by 0.16. 42 into 0.16. 6.72 equal to D plus 0.2 divided by 0.16. 1.25 into 6 minus D. Okay. 6.72 equal to D plus 1.25 into 6. 7.5 minus 1.25 D. 6.72 minus 7.5 minus 0.78 equal to minus 0.25 D. Minus and minus on both sides cancel. Okay. Next. So D equal to 3.12 rupees 3.12. Dividend payout ratio equal to dividends on earnings into 100. Dividend 3.12, 6 into 100 divided by 6 into 100, 52%. Is the answer. First of all, everyone tell me, did you all understand the working? Don't do like a robot. Are you all understanding and doing it or not? Everyone? Have you all understood? Everyone is replying 52%, 52%, 3.12, yes, yes, 52%. Okay. Done. Done. Next. Illustration 3 also completed. Different type of question we have done. Okay. Next. Come to book back questions once. Come to book back question. Yeah. Mark this very, very important. Expected question in September 25 exam. Good question. Following information is supplied to you. Total earnings, equity shares, dividend paid, price earnings ratio. Okay. Everyone tell the answer. When price earnings ratio is given and KE is not given, how to calculate? When price, I will ask two questions. Both the questions you answer and put in the comments box. Okay. Participate. Price earnings ratio is given as 12.5. KE they did not give. Okay. I wanted to know from you how to calculate KE when price earnings ratio is given but KE is not given. And the second one, what is the answer in this question? What is the KE? Give the answer. Participate. Don't sit idle. Okay. Very good. Now everyone has tell the formula. Now tell the answer. See, around 170 participants are there. Everyone should answer. Exam you are also writing na? You didn't come and watch this video just like an entertainment purpose. This is education content. Once you sit with some respect on the subject. Okay? That's a minimum expectation. Very good. Super. So everyone has given the answer. So K equal to 8%. K equal to 8%. But the importance of this question is, in this question, R also not given. What also not given? R also not given. Sir, R also not given means how to do, sir? KE, R if you give, I can compare both of them and tell the optimum policy whether followed or not. KE, okay. Of course, using PE ratio, we have calculated KE. But what about R? See here. Number of equity shares, 20,000. 100 rupee each. Dividend paid 1,50,000. Total earnings is 2 lakh. Total earnings is 2 lakh. Okay. Listen carefully. Totally 20,000 equity shares are there. For that, I gave earnings of 2 lakh. Okay. So, 20,000 equity shares means 100 each. 20,000 into 100 comes to 20 lakh. I got earnings of 2 lakh on a capital investment of 20 lakh equal to how much percent? 10%. So R equal to 10% in the given case. Did you understand this working clearly? Yeah? If nothing is given, calculate directly as the earnings on capital. My capital is 20 lakh. On that I got a earnings of 2 lakh. So my return on capital, return on investment, return on equity is how much? 10%. Understood? Okay, see, but actually that is how we can do this question, but we cannot do like that na. Always we can't remember like that. If the question comes like this, do like this, fool only will tell like that. I am not a fool. I think you are also not a person like that. Okay, you are also a logical person like me here. So therefore, let us go into a different kind of understanding of the same concept. Even in a worst case scenario, you will be able to answer the question properly. Okay, see here. This will be useful again in ratios chapter. At that time, don't put the face. Okay, dividends chapter we will use this formula. Ratios chapter also we will use. At that time, don't put that face. So listen, I will explain here itself. EPS equal to BVPS into ROE. EPS equal to BVPS into ROE. What is BVPS? Book value per share. Book value divided by number of shares will give you book value per share. Okay, so BVPS means what? Book value per share, also called as the BVPS. So book value divided by number of shares will give you book value per share. Next, return on equity. See, always remember, return on investment, return divided by investment. Return on capital, return divided by capital employed. Okay, return on equity, return divided by equity. Sir, what is equity? It's not equity share capital, it is equity. Equity has two things inside it. Equity share capital, reserves and surplus. Ratios analysis chapter it will come. Equity share capital plus reserves and surplus. Plus reserves and surplus. Debt equity ratio is there, na? Which one? Debt equity ratio. At that time, preference also will be added to this. What also will be added? Preference. Ratios chapter we will see that. When equity includes preference, when equity do not include preference, all these doubts will come in ratios chapter. There I will discuss when we discuss about the formula. Now listen carefully. Equity equal to equity share capital plus reserves and surplus. But in this question, reserves and surplus is not given. Therefore, only equity share capital will be there. So listen carefully. EPS equal to BVPS into ROE. First listen. I will take this. Return on equity. Return divided by equity. Equity means what? Equity share capital at book value, not market value. Reserves and surplus at book value. If you remember, cost of capital chapter I used to tell one point. Whenever you calculate market value weights, reserves and surplus will not be there. It is said to be included into the equity share capital. So only book value calculations only reserves will be separated. Market value reserves will not be separated. Those are also included into the equity share capital. Had we discussed about this in cost of capital chapter or not, everyone? Okay, so book value of reserves and surplus will come only when you do book values. Market value reserves and surplus is not separately shown. It will be included into the equity share capital. So see, return divided by equity. Equity means equity share capital plus reserves and surplus. Reserves and surplus. Okay. Now, return means what? We are talking about equity shareholders. Equity shareholders want EBIT, debenture holders want it. EBT, government want it. EAT, preference shareholders also want it. EAT minus preference dividend, yes, that's called as a net earnings. Also called as what earnings? Net earnings. Simply, I will call it profit after tax. Let us assume preference share capital is not there. If preference share capital is also there, profit after tax and preference dividend. So profit after tax. Okay. So return on equity is nothing but return on equity. We are talking about what? Equity share capital at book value, reserves and surplus at book value. Okay. Return means PAT or EAT. Okay. Divided by equity. Now what I will do is a numerator and denominator. I will divide it by number of shares. EAT by number of shares by equity by number of shares. Equity is also called as book value. So ROE equal to EAT by number of shares is called as what? EPS. Okay, equity is also called as what? Book value divided by number of shares. ROE equal to EPS divided by book value divided by number of shares is called as what? BVPS. Okay, so EPS equal to BVPS into ROE. This is how this formula came. Do you all understand and agree with the formula or not? Understood? Okay, why I am telling this formula is, see, I told na, a fool only will mug up the formula. A fool only will tell illogical formula. You should understand the entire idea behind. Do you know why? In exam or in this question, they have given earnings. Next attempt, you will go to exam hall. They will add resource and surplus to the question. At that time, what you will tell? Kaushal Kesh didn't tell. So you should not get that problem. Okay, you should not get that problem. So if reserves is given, what you have to do? To this particular 20,000, you should also add reserves and surplus. Like that, you have to understand. Okay. So see, ROE equal to, sorry, EPS equal to BVPS into ROE. Okay. How this formula came is the subject. First, let us understand what is this. Some people are asking me to repeat. That's why I am repeating. Return on equity. So what is equity? Equity means book value of equity share capital plus reserves and surplus. Book value of equity share capital plus reserves and surplus. And in the balance sheet, in the books of accounts, how much is the equity share capital, how much is the reserves and surplus? Both together is called as equity. Equity can also be called as a book value. Okay. Equity is also called as book value. Equity divided by number of shares is called as a BV divided by number of shares. That will give you BVPS. So ROE, return on equity, means what? Return divided by equity. Return means EAT. Equity means book value. Another name for equity is book value. So I will divide numerator and denominator by number of shares. That will become EPS. This will become BVPS equal to ROE. So how to write? EPS equal to BVPS into ROE. This is how the formula came. Now did you understand? Those who asked the doubt, did you understand now? Hello? Clear? Yes, as one person is asking me to solve one May attempt question, I will solve that. Let us complete this first. Okay. See, now in this question, let us do all the points now. First, everyone start doing. Start doing. Number one, KE equal to 1 by PE. 1 by 12.5. 8%. 8%. Start doing. R equal to R under return on equity equal to BVPS into ROE. Sorry. EPS equal to BVPS into ROE. Now we have EPS. So we have EPS. Now what we want? We want ROE. ROE equal to EPS divided by BVPS. ROE equal to EPS. EPS 20,000 divided by 2 lakh. 10 divided by book value per share 100 rupees. ROE equal to 10%. This is a right way of answering the same. In both cases, answer is 10%, but the way in which you answer makes the difference. So that's how the presentation will carry marks in exam. Okay. Next, first question. Analyze whether the company is following optimum dividend policy. Now you people will answer. R equal to 10%, KE equal to 8%, KE equal to 8%. Company paid dividend of 1,50,000. Optimum, not optimum. That's it. Tell me. Whether company is following optimum dividend policy, not following an optimum dividend policy. Optimum, not optimum. Not optimum. Why it is not optimum? As per Walter model, if R is greater than KE, company should follow 0% dividend and 100% retention. But here you are giving almost 2 lakh, 1,50,000 you are paying. So not optimal. But example, you have to write it completely. As per Walter model, what is the policy? Since company is not following that, it is not following optimum dividend policy. Next, compute the PE ratio at which dividend policy will have no effect on value of a share. Okay, compute what ratio? PE ratio at which dividend policy will have no effect on value of the share. First you have to tell when dividend policy will not have any impact on the share. When dividend policy will not have any impact on share. I told you this with the explanation and formula derivation also. When dividend policy, and whether you pay dividend, whether you don't pay dividend, it doesn't have any impact. When that will happen? When R is equals to KE. When R is equals to KE, that concept will come. So when R is equal to KE, see, what is the R? 10%. So what should be KE? KE also should be 10%. If R and KE are 10%, then there will be no effect on value of share. But he is asking not this. He is asking what should be the PE. I told na, KE equal to 1 by PE. PE equal to 1 by KE. Already we know KE. Okay. So PE equal to 1 by KE. That equal to 1 by 0.1. 1 by 0.1. 10 times. PE ratio will not be in percent. PE ratio will be in times. 10 times. Everyone answer understood? Next, will your decision change if PE is 8 instead of 12.5? Will your decision change if PE is 8 instead of 12.5? So instead of 12.5, PE is 8. If PE is 8, KE equal to 1 by 8. 1 divided by 8 is 12.5%. KE will become 12.5. R equal to 10%. In this case, R greater than KE or less than KE? Everyone. In this case, R is greater than KE or less than KE? Reply, all the concurrent viewers who are staying live. You should answer. R greater than KE or less than KE? R is less than KE. Now listen. When R is less than KE, what you should do? 100% dividend, 0% retention. But even in this case, it's not following optimal because in 2 lakh should be paid, but only 1,50,000 is paid. Therefore, will your decision change? No. Even now, company is not following optimum dividend policy because as per Walter model, if R is less than KE, company should go for 100% dividend and 0% retention. Here they have paid only 1,50,000. Still they retain 50,000. Even in this case, they are not following optimum dividend policy. Everybody understood the concept clearly. Shall we go into the next concept, Gordon model? Everyone, can you go to the Gordon model? Okay. Now we completed this. Let us move on to the Gordon model. See, Gordon model is also called as, please listen carefully. Okay. Mithun Kumar Reddy, I saw your question. Yeah. Solve, may attempt question C, 1C. I will do. Let us complete the main part. Okay. I saw your question already. See, Gordon model. In Gordon model is also called as dividend growth model. Which model here? Dividend growth model. See, I will tell you genuinely one point. Gordon model, two formulas are there. P naught equal to E into 1 minus D whole divided by KE minus BR. P naught equal to D1 by KE minus G. Okay. How this formula came? If you understand this formula, refurbishment of this concept became this one. Okay. Now listen. This formula derivation I have done in the class. Very big 2 pages derivation will come. That I am not going to do now and waste your time. Okay. Just remember this formula. If everyone remember in the class, main class, I derived the formula for this. Correct? Okay. So that I have done already. Or I can do one favor for you. We will take break. Na? Break time, 5 minutes if you give me, I will derive this. Interested can listen. Not interested can have a breakfast. Okay. I will tell how this formula came. If you are interested, you listen. If you are not interested, go for breakfast. But in the break time, I will discuss about this. Are you clear, everyone? Did you understand what I said? Okay. Now see here. What is... Okay, done. Now listen. Let's come back to the story. Gordon says like this. There are 3 kinds of firms. Growth firm, stable firm, and declining firm. Or stage. Growth stage, stable phase, declining phase. Or growth firm, stable firm, declining firm. What is this concept? See here. See here. Walter said if R is greater than KE, 100% dividend, 100% retention, 0% payout to have optimum price. To have optimum price. Walter said if R is less than KE, 100% dividend, 0% retention to have optimum price. Gordon is a more wise person. Okay, more intelligent and smart person. He did not tell anything about R and KE. How much listening? What to do? Whether to pay high dividend, low retention, or high retention, low dividend? What to do? Which is good? He said, take different scenarios. Okay, take different scenarios. And 100% dividend, 0% payout. 100% retention, 0% payout. 90% retention, 10% payout. 80% retention, 20% payout. Take different combinations. Which combination you are getting highest P naught? Okay, follow that. Better, na? Why to unnecessarily break your brain? How much is R? How much is KE? No need. You put R number, you put KE number, you put your dividend retention percentage, everything. Calculate. If you are at what R and KE combination higher price is coming, na? Go for it. Understood the point clearly? Everyone? Understood? Are you clear, everyone? Shall we continue? Yeah. So P naught equal to D1 by KE minus G. P naught equal to E into 1 minus D, 1 minus B whole divided by KE minus BR. First, EPS. Retention proportion. Not retention percent, proportion. Because 1 minus we have to do. And 60% means 0.6 we will write. B means retention proportion. KE, cost of equity. B, retention proportion into R, return on equity. This BRA we will also call as G. G equal to B into R. That's why it became. Next, P naught. Here also P naught. Current market price per share. D1, expected dividend. KE, cost of equity minus G. G is nothing but B into R. Okay. Now question. Sir, when to use this formula? When to use this formula? In the question, they gave you R, they gave you KE. They gave you R, they gave you KE. And retention percent. Use the first one. Nothing is given. They have given only the dividend already paid in the last year and growth, then go for the second formula. Most of the times in exam, they will ask first formula. Okay. Second formula also they will ask, I will not deny that, but in a different way they will ask, not in the garden formula. Okay. Let us start. First of all, everyone tell one yes. Did you understand whatever I discussed till now? Honestly, you tell. If you say yes, start doing the problems. 3 problems we will do also in garden model and complete the garden. Then we will be going into the next area called as a Modigliani-Miller. Everybody. Can we move on to the next one? Yeah. So let's do the problems now. Okay. Let us take third question and do as per Gordon's model first. Okay. E 10, D 6, K 20, R 25, retention 40. Full data is given now. Which formula we should use? 1 or 2? 1, 2. What we need to use now? 1, 2. There are 2 formulas na. 1 or 2? Which one to follow? In this case. In this question, which one to use? 1 or 2? Participation. Everyone answer properly. This is your exam. So you should be more involved than me. So let us use the formula 3. P naught equal to E into 1 minus B whole divided by K minus B into R. E 10, 1 minus retention proportion 0.4 whole divided by KE 0.2 B retention proportion 1 minus 0.4 means 0.6. 0.6 into 10, 6 divided by 0.4 into 0.25, 0.1. So 0.2 minus 0.1 is 0.1, 60. Have you all got the same answer? Have you all got the same answer? 60. Okay. Next. This assignment question is for you. Okay, this question is for you. I will give you 3 minutes time. Okay. Exercise question for you. Do it now. 3 minutes. Time starts now. Begin. Must do question. 3 minutes time given. Everyone participate. Do it. One more minute time for you left. Time up. Give the answers. Okay. We have got some answers now. Let us check the answers. We have got some answers. See, net profit 50, net profit 50 lakhs, preference shares 100 lakhs. 100 lakhs is a preference shares. Dividend will become 15 lakhs. Number of equity shares 5 lakh. Return on investment R, K equal to 16. Garden model we are going to calculate. If dividend payout is 25, means B equal to 0.75, B equal to 0.5, B equal to 0. Have you all understood the 3 points clearly? Yeah. First case, asal net profit how much? 50 lakhs minus 15 lakh divided by 5 lakh. So EPS equal to 7. EPS equal to 7. Formula is what? E into 1 minus B whole divided by KE minus B into R. 0.75 into 0.2. 1 minus 0.75 into 7 divided by 0.01. 175 is the first answer. 175 is the first answer. Next, if retention is 50%, then what will happen? 1 minus 0.5 into 7, 3.5 whole divided by B into R, 0.5 into 0.2, 0.1. So 0.06. So 3.5 divided by 0.06, 58.33 will be the answer for the second bit. Third one you calculated already, 43.75. Sir, everyone in the class have got the same answer or not? 175, 58.33, 43.75. 2 bits I have also done along with you. Everybody answer. Did you all get the same answer? Very nice. So now 2 questions we have done enough. That is how the concept relating to the gardens model will run. Now let us go into the main king of the ring, MM theory. Next 30 minutes. Okay, listen. Those who are listening to my words now, please listen carefully. Next 30 minutes, focus properly. We are going to do 3 questions. 2 questions we will do, 1 question you will do. I will be giving you 4 minutes time because it's a 5 marks question. So 4 minutes time I will give for you to solve. First question I will solve, second question we will solve, third question you will solve. Let us solve 3 questions on Modigliani-Miller. Are you all with me? Shall we begin? Modigliani-Miller theory. Stay live everyone. Okay, let's begin. What is the concept? theory. Modigliani and Miller theory. So let us understand the concept clearly. Let's begin. See here. Modigliani-Miller theory. How to understand Modigliani-Miller theory? See. Modigliani-Miller theory. First I will tell the disclaimer and begin. Regular class, 2 classes I will take for Modigliani-Miller theory. 1 class of 3 hour session to explain the concept. 1 class of 3 hours to solve the questions. So 6 hours is the time taken for theory in general. Okay. But we have to complete the same 6 hours content in 30 minutes now, along with 3 problems. Means I can't explain entire overview of the entire concept of theory. I will give you the overview what is required for exams. Okay. See. Modigliani-Miller has given 3 formulae. Listen. Number 1. He gave pricing formula. D1 plus P1 divided by 1 plus KE. Next, he has given amount to be raised by public offer. Amount to be raised by public offer. Amount to be raised by public offer. Listen carefully. Amount to be raised by public offer will be called as a MP1. Will be called as what? MP1. P1 means the price at which shares are going to get issued. Okay. P1 is price at which the shares are going to get issued. Or if you don't want it to learn this way, I can also tell an alternate one. First formula, everyone understood the point clearly. Yeah? See how this formula came. Value of a share is nothing but present value of future cash flows discounted at required rate. Okay. PV equal to FV divided by 1 plus R whole power N. N is 1 year. Therefore, if you write N or not, it doesn't make any difference. Power la 1. So, power la 1. So, 1 is insignificant. Therefore, we remove. PV equal to FV divided by 1 plus R. Future value. When I buy a share, I will get 2 future values. Number 1. I will sell the share at P1. I will receive dividend at D1. Therefore, we call it as a D1 plus P1 as a future value. Divided by 1 plus R. R here represents a required rate, not return on equity. That is in the Walter Garden, not here. So, K. So, P not equal to the present value of a share is nothing but present value of future cash flows discounted at a required rate. Up to here, everyone understood the point clearly or not? First, tell me this. I'm waiting for everyone's answer. Everyone, I'm seeing your answers. Okay. Okay. Next formula he has given is MP1 equal to I minus E minus ND1. Write down. Meaning I will tell you. First write down. MP1 equal to I minus E minus ND1. I minus E minus MD1. Meaning, see, first of all, you need to understand one point. Listen carefully, please. Company is going for investment. Company is going for investment. I have 10 rupees with me. I have 10 rupees with me. I have investment opportunity available 10 rupees. Now, I will have three options. Retain this 10 rupee, use it for investment. No. Some part I will pay. Partially, I will pay dividend. Part amount I will invest. I will 100% pay full amount until zero I will be available to invest. See, full, partial, zero. Listen carefully. Modigliani-Miller approach in a simple format. I have 10 rupee earning. I have 10 rupee investment also. What to do now? I can 100% retain and put it in the investment. Option 1. No. I will some part, 5 rupee I will pay as a dividend. 5 rupee I will be investing. Remaining 5 who will give? Remaining 5 I will go for public offer. Here 100% I will pay. Means 0 I will be having. So entire 10 rupee I will go for public offer. See what I am saying? Second and third, put your mind clearly here. Okay. What I have explained in 6 hours, I need to explain in 6 minutes. So please listen carefully. Partially I am paying dividend. Until remaining partial I need to go for public offer. 10 rupee investment opportunity is there. Okay. 10 rupee already, 5 rupee already paid as a dividend. So 5 rupees only retained, but remaining 5 who will give to invest? Public offer I will go. Point number 1. Now understand with a clean slate of mind. Partially I paid dividend. How much dividend I made? 5 rupee dividend I paid. Correct? Now you answer my question. This 5 rupee is D1, dividend that I am going to pay. Okay. I will ask you one question. Common sense you use, if any, and answer. Okay. Listen. D1 is 5 rupee. After paying the dividend, you will go for public offer, or after going for public offer, you will pay dividend. First, what will come? Dividend and public offer and dividend. Which is the right sequence? Dividend and public offer and dividend. Either 1, either 2. Tell the answer clearly. 1 or 2. Which is the right sequence? Or both can be done. Okay. So now we understood that sequence is number 1. Dividend and public offer, not public offer and dividend. Okay. Sir? Why not public offer and dividend? I will do like that. No. Public offer, you will raise money. You will pay dividend means, it means you are taking money from the public and you are paying dividend. Dividend must be paid out of company profits or from the free reserves. Company said what it said, dividends can be paid out of current year profit or from the past profits or out of both, not out of public money. Public offer, raise money and pay dividend, that concept itself is not permitted by Companies Act. So you cannot go for public offer and dividend. You can go for dividend and public offer. Everyone understood the logic or not? Why it is like that? This is what we call about the logic in understanding the concept. Fool will just tell this. A wise person will know what is there behind the reasoning. Did you understand what I said or not? So again and again I am telling you, if you wanted to become a gem of a guy in CA final, learn CA inter FM in a proper way. Not just in 2 formulas, 3 concepts, 35 answers. No. Understand the reasoning behind why it is like that. Then you will also become a Modigliani-Miller. You will also get a Nobel Award. Yes. So now let's come to the point. What is the logic here? partially I paid dividend. 5 rupee I paid dividend. Okay, now I will ask you question. Tell me, I will pay this dividend and then go for public offer. Correct? Until by the time I am paying dividend, new shareholders didn't come. Okay, old shareholders will be there. Old shares are called as N, new shares are called as M. So I will pay this 5 to N number of shares, M number of shares. Answer. I will pay 5 rupees to M number of shares, N number of shares. M means new, N means old. Since you are paying and going for public offer, by the time you are paying, new shareholders didn't come. Therefore, you will pay to N number of shares, not to M number of shares. Very good. Everyone is replying. So, therefore, I call 5 as a D1. So, I call 5 as a D1. So, N into D1, this is right, this is wrong. Therefore, N D1, this is how this part of formula came. Understood the point or not? What I said, I have 10 rupee earning. I have 10 rupee earning, 10 lakhs or 10 crores. 5 crores I paid as a dividend. What is this dividend? 5. 5 is called as ND1. 10 is called as earnings. So 10 minus 5. 5 crores I need to go for public offer. That itself is E minus ND1. E minus ND1. So see, investment 10 crore. Earnings 10 crore. Dividends 5 crore. Okay. Now tell me, complete 10 crore I need to raise by public offer? No. How much I need to raise by public offer? I will raise a public offer from M number of shares at the P1 price, because I will pay dividend at the end of the year. End of the year price is not P0, P1. So at P1 price to M number of shareholders, I need to issue shares. This is amount raised by public offer. This will be equal to complete 10 crores I need to raise. No. My investment is 10 minus what is my earning? 10 crore minus dividend is paid to whom? N number of shareholders at a D1 rate. Okay, this is dividend paid to existing shareholders. This is investment opportunity. Investment opportunity. So how much I need to raise by public offer? Investment opportunity minus dividends paid. Investment opportunity minus dividends paid, or net earnings. I call it net earnings. Balance only we need to raise by MP1. Did you all understand the formula clearly? Yeah? What I used to discuss for 6 hours concept, I tried to explain 6 minutes. Did you understand the whole idea or not? Everybody? Okay. Third formula. So 2 formula already we completed now. Okay. Next. NP not equal to NP not equal to. Okay. Sir, up to here you have written formula 1, formula 2. Okay. P1 into N plus M minus I plus E whole divided by 1 plus KE. Write down. P1 into N plus M minus I plus E whole divided by 1 plus KE. P1 into N plus M minus I plus E whole divided by 1 plus KE. Okay. Have you written the formula, everyone? This is called as existing wealth calculation. This is called as existing wealth calculation. N is number of shares. P naught is price now existing. P naught is existing price. Into number of shares, the total share value will come. Wealth called as a wealth. Existing wealth calculation. Okay. Understood? See, P naught equal to D1 plus P1 divided by 1 plus KE. Correct? D1 plus P1 divided by 1 plus K. From this only this formula came. Okay. So from this only this formula has come. So I'm not going to derive that formula and waste my time. First of all, everyone understood these concepts clearly. All the three concepts. Shall we start doing the problems now? Can we start with the problems on Modigliani-Miller theory? See, what I said you, I will do one question. You will do, we will do one question. Lastly, you will do one question. Then we will take a break. Such that the main 85% of this chapter will get completed. 6 marks pakka. Okay. Let's take it. See, finally, before we start with the question, Modigliani-Miller proved that whether you pay dividend, whether you do not pay dividend, the wealth of the company will not change. Will change or will not change? Will not change. Irrelevance theory. Okay, let's see. M Limited belongs to a risk class for which capitalization rate is 10%, KE 10. It has 25,000 shares. Market price is 100. It expects a net profit of 2,50,000 per year, and the board is considering a dividend of rupees 5 per share. M Limited requires to raise rupees 5 lakh for an approved investment expenditure. Illustrate how the MM approach affects the value of M Limited if the dividends are paid or not paid. Let's begin. I will do first. Okay. First question I will do, as I already said. Second question we will do. Third question you will do. So therefore, see here once. Full participation required. Complete participation of all the students. Okay, see what they are asking one by one. Let us have a clarity. M Limited belongs to the risk class. KE is 10%. 25,000 equity shares. Market price, current market price, P naught. It expects a net profit of 2,50,000 for the year. Next, board is considering dividend of 5 rupee per share. First of all, let us do the first step. Step 1. What is asking? Calculation of P naught. Dividend paid, dividend not paid, both cases. First listen carefully. Not paid, paid. P naught equal to D1 plus P1 divided by 1 plus KE. P naught equal to D1 plus P1 divided by 1 plus KE. Okay, see here once. P naught, already they have given how much? 100. Okay, next D1, dividend not paid means D1 will be 0. P1 we don't know. KE already given 10%. So 1.1. So P1 equal to okay 100 into 1.1. P1 equal to 110. Next P naught 100. D1 dividend how much they wanted to declare? 5. If dividend is paid 5 plus P1 divided by 1.10, so P1 equal to 110 minus 5, 105. First everyone tell me step number 1 everyone understood clearly or not? Dividend paid price is 110, price is 105, dividend not paid price will be 110. First of all everyone reply, did you all understand the step number 1 clearly? Step 1 everyone understood clearly? Participation, important concept. Stay live. Okay. Now, so 110 and 105. So this is what we have done. Next, what is the second step? He is asking us to see, it wanted to raise 5 lakh rupees for investment. Illustrate means explain how approach affects the value of M Limited if dividends are paid or not paid. Dividends are paid or not paid. See, second, step 2. Amount to be raised. Okay. First, dividend not paid. Dividend not paid. Okay. MP1 equal to I minus E minus ND1. M, we don't know. P1, dividend not paid. What is the P1? 110 equal to investment opportunity. How much? 5 lakh. If dividend is not paid, ND1 will become 0. Okay, dividend not paid. What is the earnings of the company? 2 lakh 50. So 110 M equal to 2 lakh 50,000. M equal to 2 lakh 50,000 divided by 110. 2272.73 shares I have to issue. Everybody understood the concept clearly or not? How many shares to be issued if dividend is not paid? Everyone understood this calculation clearly? Okay. If dividend is paid, MP1 equal to I minus E minus ND1. M, we don't know. P1 is 105. Dividend is paid. So at 105, we need to raise. So 5 lakh minus E 2 lakh 50 minus ND1. How much dividend you are paying? 5 rupee dividend. Total shares are how much? 25. So 25,000 into 5 rupee. 1,25,000 we need to reduce. So 105 M equal to 5 lakhs. Okay, 5 lakhs minus 1,25,000. M equal to 3571.43. 3571.43 shares. Everybody answer, understood the point clearly? Hello, I'm talking to you. Have you understood the concept up to here, everyone? Okay. These are the number of shares we have to issue. See what he is asking. Affects the value of M Limited if the dividends are paid or not. Okay. See, I will give you wealth analysis. Step 3 is wealth analysis. See, he did not tell in the question whether he wanted you to calculate existing wealth or future wealth. He did not tell anything. If we tell current wealth, NP not formula we have to use. Okay. If we ask the future wealth, then we have to apply the same formula and tell the justification. You did not understand what is written? Listen carefully. Wealth after public offer. Please listen. These adjustments are very important. Please listen. Dividend not paid. Think of the thing. Dividend is not paid. Okay. Already N is there. How many shares are there in the company already? 25,000. How many M shares are issued? 2272.73. What is N plus M? 73. Okay. Wealth after public offer. Now after public offer P1. So P1 is how much? 110. So what is the total wealth? 272.73 into 110. 30 lakh. This is dividend not paid. Dividend paid. N 25,000. M 3571.43. N plus M 28,571.43. P1 equal to 105. Wealth equal to 28,571.43 into 105. Again 30 lakh. As per Modigliani-Miller, we proved that the wealth of the company will remain the same whether you pay dividend, whether you do not pay the dividend. Everybody understood the wealth after public offer calculation or not? Everyone? Reply, yeah, important concept, reply. Okay, done. Next, wealth existing. Wealth existing. Dividend not paid. NP not equal to P1 into N plus M minus I plus E whole divided by 1 plus KE. That equal to P1 110. We already told this now. 27,272.73 minus I 5 lakh plus E 2,50,000 whole divided by 1.10. So 110 into 27,272.73 minus 5 lakh plus 2,50,000 divided by 1.1. 25 lakhs. 25 lakhs. That is clear, na? 25,000 shares, 100 rupees each. Proved. 25 lakhs. Next. Dividend paid. Dividend paid. Same formula. 105 into 28,571.43 minus 5 lakh plus 2,50,000 whole divided by 1.10. 28,571.43 into 105 minus 5 lakh plus 2,50,000 divided by 101, 1.1, 25 lakhs. In this case also, wealth remains the same in both the cases. Everybody, now you answer. Did you all understand the Modigliani-Miller approach, how to do in exam? So, whether they are asking, if they don't ask anything, do both. And wealth after public offer you should do, wealth existing also you should do. If they clearly say, do wealth after public offer, then do this first one. No, do the wealth existing, current wealth, then you should do the second one. Depending on the question, you need to do the answer. Did you all understand or not? Everyone, did you all understand? Okay, done. Now we understood Modigliani-Miller one question. Do one thing to save time. I have done one question now. Now you do one thing. You do this question and close. We'll take a break and start with the dividend discount model, also called as the two-stage dividend model. Two-stage dividend model we will do first. Once completed, then we will be going into two-stage dividend model. One or two questions in the study material we will do. We'll complete this and then we'll go into the next chapter. Okay. Main thing that 85% content will be completed with the Modigliani-Miller itself. Next one is only two-stage dividend model, which is similar to Gordon. See this. 7th question. Akash Limited has 10 lakh equity shares outstanding at the start of the accounting year. Existing market price is 150. Existing market price per share is 150. Expected dividend 8 per share. Rate of capitalization appropriate to the risk class to which the company belongs is 10%. See, how many lakh equity shares are there? 10 lakh. Okay. Existing market price 150. Dividend D1 expected is 8. KE equal to 10%. Calculate the market price if dividends are declared, dividends are not declared. One question. Calculate the number of shares to be issued at the end of the accounting year. That's why MP1. On the assumption that net income is 3 crore, investment is 6 crore. Do for both, dividend declared, dividend not declared. Prove that the market value at the end of the accounting year. And first model he is asking. And a wealth at the end, not wealth at the beginning. Wealth at the beginning, NP0 formula will come. NP0 formula. If it is to be end of the accounting year, MP1 you should compare. And you need to do this way. Okay. If dividend is declared, dividend is not declared. Everybody, are you taking the challenge? If you are really ready, put the message, challenge accepted. I'm giving you exactly 4 minutes time. You have to do it. Are you ready for this? Everyone. Start then. Start. Your time starts now. Start doing it. Everyone, take the challenge, do it properly. Start, everyone. Accept the challenge. Start doing it. 5 marks guarantee in the exam. First bit everyone completed. If you have completed, give the answer. Have you all done with the answer? Everyone? Have you all done with the answer? $157 and 165, 2,42,000 and 1,82,000. Odd. If you get decimals also, no problem. You can do it that way. Next one, 1950, 1950. Also called as 19 crore 50 lakh, 19 crore 50 lakh. Everyone have got the answer clearly. I'm talking to you. Done. Now we have completed which concept? Modigliani-Miller we completed. So the main three concepts, what is the substantial part of this chapter, that is completed. Okay. Now listen carefully. Let's take a small break and come. Okay. 10 o'clock we will again reassemble. What we will do is first I will explain about the dividend discount model. What model? Dividend discount model, also called as the two-stage dividend model. Two-stage dividend model, two questions are there. Let us do those. Understand it. After that, then I will be going into the next area. Chapter I will change. I will go into next small area called as the leverages. Okay. Let me complete that. Once done, then we will go to that buyback and bonus offer. Clear? Buyback, bonus offer, stock split. If you are having no clarity on that areas, I can do one thing. I will be uploading the video. You can listen to the complete content. See, most of the students don't even know what is the impact of buyback on the wealth. Most of the students don't know what is the impact of bonus offer on the wealth. For all of you, I can do one thing. I have a video content already available. Almost around 3 hours it will come. Bonus buyback will be in detail discussed there. Okay, that video I will upload, you listen to that. Such that if you already have a vision, revision makes a sense. If you don't know how the buyback actually operate, directly doing a question doesn't make any sense. Instead of saving the time, I will do that. Are you all okay with that, everyone? But once you listen to that, you will get full clarity. Okay, CA final questions I have. Those CA final questions I will put there. Okay, today by evening I will upload that. Listen to that. Then we can save time here. We can do the leverages chapter once after this. Clear? Okay. Take a break and come. We'll continue. We start. Can we continue, everyone? Two minutes, I will wait for you. Please assemble fast. We'll continue. So let us continue. Let us now start with dividend discount model. Are you all assembled? Shall we start? Everyone give a reply. So let us continue. Next concept is dividend discount model. What is the concept? Dividend discount model. I will tell you the psychology behind this dividend discount model. Once understood, you can be doing the problem in this regard. See, Gordon model formula says like this. P naught equal to D1 by Ke minus G. D1 by Ke minus G. This is what the Gordon formula says. Now, what is the problem that came? This formula will say that price of the share will be dependent on the dividends in future taken to perpetuity net of the growth. Okay, this formula derivation I will tell at the last. I told the break I will tell. Okay, last 12 o'clock like that, if I stop the session at that time I will tell the derivation. Interested people can stay and learn. Okay, so d1 by Ke minus G, P not equal to d1 by Ke minus G. This is the formula for perpetual dividends with growth. Okay, a question will happen. I wanted to know about a investor specific result. What do you mean by that? See, every investor who invests in the stocks will always invest with a time horizon. Time horizon means no one will invest only for just investment sake. Everyone will invest with a target. With what? A target. Means what? I wanted to buy, let's say for example, I wanted to buy a BMW. Okay. For example, I wanted to buy BMW car. I wanted to buy Mercedes Maybach. I wanted to buy so and so thing. I wanted to buy a gold biscuit. Like that, everyone will have a target in future. Depending on those targets, we will make investment today such that my investment will become that much amount such that I can buy the product in the later stage. This is what we have to understand. I repeat, whenever we are going to invest money, we will always invest with a time horizon. Okay, I wanted to stay in the market for 4 years. I wanted to stay in the market for 2 years. I wanted to stay in the market for 1 day. There is a time horizon. Okay, on the basis of time horizon, if you calculate the value of a share, that becomes a concept called as a two-stage dividend model. Which model here? Two-stage dividend model. How it look like? Let us see. Dividend discount model or two-stage dividend model. See, fifth question is a classic example for the same. A&R Limited is a large cap multinational company listed in BSE with its face value 100. Company is expected to grow at the rate of 15% per annum for the next 4 years, then 5% for an indefinite period. Shareholders expect 20% return on their investment. Expectation of shareholder is 20% and a cost of capital. Company paid 120 rupees as dividend per share for the current financial year. We call it D0. The shares of the company are traded at an average price of 3122 on the last day. Find out the intrinsic value per share. Sir, already they calculated 3122. Na? 3122 is the market price. Intrinsic value means what is the worth of the share. See, I will always tell this example. Anywhere FM I taken. Whenever we buy a product in the market, we have one price in our mind. Means we will decide this is a maximum price I can pay for it. That's called as a worth. Intrinsic value, also called as a fair value. What actually it is called as a market value. Clear? See, I went to the market. I wanted to buy a calculator. In my mind, I have one idea. Calculator na 200 rupees maximum. That means calculator worth is 200. Whether really priced at 200 or not is a different story. I went to the shop. I asked him, what is the price of this calculator? He said 150. Immediately buy. Because my worth I am keeping in mind is 200, but it is only 150. Immediately buy. He said 350. I will tell I don't want it to buy because maximum in my mind I can put only 200 for calculator. Same thing. Market rate is trading at 3122. He is asking for an investor having an expectation of 20%. What will be the intrinsic value of the share? Intrinsic value represents the worth of the share, not the price of the share. Everybody understood the concept clearly or not? On that basis, you will tell whether it is overpriced or underpriced in comparison with 3122. Calculator, I said what? 200, 150. Underpricing by 50. 200, 350. Overpriced by 150. Like that, here he is asking a question. Did you understand or not, everyone? First tell me that. Did you all understand the psychology of this concept or not? Two-stage dividend model. Now see how to do this. First point, there is a investor. There is a investor. That investor will enter into the market today. Will enter into the market today. Stay in the market for 4 years. Sir, how do you know, sir? He said, no, company is expected to grow at the rate of 15% for the next 4 years. Thereafter 5% for indefinite period. Sir, what does it mean? I wanted to stay only for 4 years. Therefore, in this 4 years, what happens will be concerned for me. After 4 years, I will leave the company. At that time, what will happen to the company every year? Why I will bother? Why I will bother? My concern is only about my holding period. I will hold the share for 4 years. Year 0, 1, 2, 3, and 4 years. 1 year, 2 year, 3 year, and 4 years. How many years? 4 years I will stay in the market. Okay. In this 4 years span, company will grow at what rate? Company will grow at the rate of 15%. For how many years? 4 years. After 4 years, what you will do? I will sell the share. Okay. After that, how much it will be? Why I will bother? No, tell one amount. From there till infinity. Yeah. Okay. Using conservatism principle, I will not tell 20-30%. I will take a least amount as possible. 5% infinite growth. So, after that, 5% will be the growth in the company. Yes. So, shareholders expect 20% return on their investment. See, I will enter into the market today, purchase the share at a price, stay in the market for 4 years, and after 4 years, I will sell the share. Okay. Listen, I will do it faster and I will give time. Institute study material answer, there is a mistake. I will tell you where the mistake also went. They have taken wrong percentages. They didn't even rectify that. So we will do the right thing. See here how to do. Okay. Year, cash flow, PV at the rate of expectation 20%, PVCF. See, year 1, 2, 3, 4, 4. Okay. So why we are taking 4 years for 2 times? Because in this first 4 years, growth will be 15. Growth will be 5. Just a minute. Just a minute here. Okay. So, first 4 years, it will grow at the rate of 15%. What is the current dividend paid? 120. Take calculator. Take calculator, do the calculations. 120 plus 15%, 138 plus 15%, plus 15%. Stop. So these are the 4 numbers that we will get. So next to 4 years, this is the thing. So I will enter into the market today, D0, P0. I will purchase at P0 price. I will get 138 dividend after 1 year, 158 dividend after 2 years, 182 dividend after 3 years, 209 dividend after 4th year, and at the end of 4th year, I will sell the share. Sell the share at what price? You are selling at the end of 4th year, na? We want P4. P0 will be D1 by KE minus G. P4 equal to D5 divided by KE minus G. D5 can be written as D4 into 1 plus G divided by KE minus G. What is the D4? 209.88 into 1 plus G. How much is the growth in perpetual? 5%. KE 20% minus 5%. 209.88 into 1.05 divided by 15%. 1469.16. I will explain. You purchase the share. What price? That's what we are going to calculate, intrinsic value. We will receive first year dividend 139, second year 158, third year 182, fourth year 209, and you will sell the share at the end of fourth year after taking the dividend. See, this is the dividend you received for the fourth year. This is a selling price. You are selling after taking the dividend or before taking the dividend? After taking the dividend. Therefore, this is called as ex-dividend share price. Which share price? Ex-dividend share price. Means excluding dividend, this is the share price. Okay. 20%. 1 divided by 1.2. 0.482 because both are for the fourth year. Multiply 138 into 0.833 m plus 158 into 0.7 into 0.694 m plus 182.51 into 0.579 m plus 209.88 into 0.482 m plus 1469.16 into 0.482 m plus MRC 1140.06. Everyone understood the valuation clearly, yeah? Everyone, reply, understood the concept clearly. Okay. What is the price of the share? 1140. This is the price at which you can buy the share. Okay. Now, this is priced at what price? 3,122. It is getting traded. Means it is worth 1140. Traded at 3122. It is underpriced or overpriced? Extremely overpriced. Extremely overpriced share. That's the answer for question number 5. First of all, everyone understand and tell me, do you understand what is the dividend discount model? Two-stage dividend model. Everyone, honestly tell, did you understand the two-stage dividend model concept? Okay, done. So we are now done with question number 5. See, institute mistake I will show you. Fifth question. In this chapter, 3 mistakes are there totally by the institute. Sorry. See here. They have taken all these now. 120 into 1.15. Okay, 120 into 1.15. See, 120 into 1.15. You got 138. 138 into 0.833. 114.95. They have taken 115. That is okay. Approximated they will do. But the problem, what they have done is, see here. Here, 20% minus 5%, 209 we have to take now. Growth also they have taken 15% even for the last year. You can see here. Understood? 209.88 perpetual period it will grow at 15% or 5% or 5%, not at 15. They have taken 15 here. This is wrong. This should be 1.05, not 1.15. Rectify that in the study material. It's a mistake. First year okay, second year okay, third year okay, fourth year okay. I am holding it for 4 years na. Fourth year I will sell. By the time I am selling na, future la what is the expected rate for infinite period? 5%, not 15. They have by mistake taken 1.15 instead of 1.05. That's why the answer came wrong. But even in that case, one thing is clear. We got 1140. They got 1022 in both the cases. It is extremely overpriced. Did you rectify the answer in the study material, everyone? Okay. So this is about the two-stage dividend valuation model. Okay. Okay. Buyback bonus, I told you I will separately upload the full content because so many students don't even know that that concept is available. So listen to the main regular content itself. CA final I taught already. That content if you listen na inter jujupi, just like that you will do and you will throw it away. Okay. So let us now move on to the next area of our revision. Okay. Please come to the chapter leverages. Okay. Leverages. See, any question in leverages chapter, any question, 90% questions or even 95% questions. And if you take 10 questions, 9 questions out of 10 questions in leverages chapter, step 1 will be always income statement. Is always income statement. See here. Leverages. Whenever I say leverages chapter, see, sales minus variable cost contribution minus fixed cost EBIT minus interest EBT minus tax EAT minus preference dividend earning available to equity shareholder divided by number of shares is EPS. Okay, divided by number of shares is EPS. If preference dividend is given, this is the logic. Sorry, let us for simplicity's sake understand preference dividend itself is not there. Then what will happen? EAT divided by number of shares will come to EPS. Okay. Now listen. So sales variable cost contribution, fixed cost, EBIT, interest, EBT, tax, EAT divided by number of shares EPS. Okay. Now listen carefully. 100, 60, 40, 10, 30, 10, 20. Okay, let's say tax is 10%, 2 rupee. $18. Let us say there are 18 lakhs. This is 1 lakh shares are there, or 2 lakh shares are there. 9 rupees is the, everything is in lakhs. 9 rupees is the EPS of this particular company. This is the leverages first income statement. Listen carefully. First 10 minutes is the crucial thing for leverages chapter. 10 minutes did you understand? That's it. Remaining chapter, no help needed for you. You will do on your own. So listen. First, leverages chapter is always talking about how the bottom line of an income statement is affected because of the top line of the income statement. Okay. How bottom line of the income statement is affected by top line items. Simply to tell how the top line of the income statement influences the bottom line of the income statement. Okay. So what do you mean by top line? What do you mean by bottom line? See, income statement is broken into two parts. Okay. I repeat, income statement is broken into two parts. Exactly in the middle. This is called as top line of the balance sheet. Sorry, income statement. This is called as bottom line of the balance income statement. So one is a top line items, another one is a bottom line items. Okay. How top line item influences the bottom line items is the subject of leverages chapter. So the impact of top line items on the bottom line items is the subject matter of discussion. Okay. See here, I will give you an example. Leverages idea is very clear. How sales is going to, sir, is it top line, bottom line? I said, okay, breaking into two parts. But in this, again, top line, bottom line will be there. When you compare sales and contribution, sale is a top line item, contribution is a bottom line item. When you compare contribution EBIT, contribution is the top line item, EBIT is the bottom line item. EBIT and EBT, EBIT is the top line item, EBT is the bottom line item. EBT and EAT, EBT is the top line item, EAT is the bottom line item. EAT and EPS, EAT is the top line item, EPS is the bottom line item. So did you understand each and every 6 points I said you now? Do you all understand what I am shouting? So, logic is very simple. Income, always balance sheet. Listen. Income statement is broken into two parts. Sales to EBIT part 1, EBIT to interest to EPS is part 2. Again, we can break that into small parts, top line and bottom line. Okay, but sale of products, variable cost of product, contribution given by the products and services you are doing, fixed costs on the product, EBIT. These all 5 points are relating to your operations or your business. I will ask a question, tell me. This year 0, sales is 100, variable cost 60, contribution 40, fixed cost 10, EBIT will be 30. Do you give any guarantee that next year also sales will be 100 or next year sales can change? Reply. Next year sales will be same 100 or sales will change. Everyone reply, be active. So sales will be same or sales will change? Sales will change. Okay. Generally they will change. So sales will be changing. Now you answer. 100 rupees changed. If this 100 is changed, this also will change. This also will change at the same rate. Fixed cost won't change. Therefore, EBIT will definitely change. For example, if the sales next year is 90, variable cost will become 54. This will become 36. This will become 10. It becomes 26 only. So 30 became 26. Top line item changed the bottom line item. Other discussion of leverages chapter. How the top line items of your income statement show the impact on the bottom line is the subject matter of discussion we are going to do. Everybody answer, understood the point clearly or not? Everyone? Okay, next. So one thing is clear now. Observation number 1. If sales changes, delta is a change, EBIT will change. If sales changes, EBIT will change. Okay. Now I want rate of change. Now I want what? Rate of change. Rate of change, we always use differential calculus. We always use what? Differential calculus. dy by dx means change in y for the change in x. In a graph, x represents x-axis, Y represents Y axis. X is influencer, Y is influenced. Okay. Now, EBIT is influencer. Sales is influencer. Who influences whom? Sales influences EBIT. EBIT influences sales. Reply. Who will influence whom? Sales influence EBIT. EBIT influences sales. Yeah. So therefore, sales influences EBIT. Influencer is x-axis. Influenced y-axis. That's why dy by dx concept came. X is something coming on the x-axis. Y is something coming on the y-axis. X is always influencer. Y is always influenced. Okay. Until this is the denominator. Down. Top part is the numerator. Okay. This is x-axis. This is y-axis. Influencer. Influenced. Okay. Who is influencer? Sales. Who is influenced? EBIT. How the influence is? That's what said in the form of a percentage. So tell me, what is in the denominator? Sales. Percentage change in sales. Numerator, percentage change in EBIT. Percentage change in EBIT. That's why operating leverage formula is, okay, business risk or operating leverage formula is percentage change in EBIT by percentage change in sales. That's how that formula is derived. Did you all now understand how that formula came? Everyone? Okay. So you need not mug up now. Why to mug up here? A fool only will mug up now. A fool only will ask you to remember formulae. A fool only will remember the concepts without knowing the logic behind. Clear or not? So, if anyone say remember the formula, first tell, are a fool. There should be some reason behind the concept, na? Yes or no? So, there should be a reason behind. That's what I always tell. So, if you want to crack big courses, okay, big courses in finance like CFA, okay, if you wanted to crack big courses in international level like CFA, okay, if in finance it's CFA, if it's in accountancy and financial reporting, CPA, okay, remaining you need not do a chartered accountancy is always on par with all other courses, international courses. And when it comes to ACCA, if you already done CA, no need to do ACCA because same kind of opportunities, maybe CA gets more opportunities than. Because CMA US now, that's a waste of time to doing it because there are only two papers in that. One is financial management, another one is a costing. These are the only two papers and there is no great research in that. It's a general paper because most of our students who has done CA Inter, since they could not qualify CA Inter, they have done CMA US and they qualified that. So nothing great in that. So it's a very simple course in itself. So, but mainly if you wanted to do something, achieve big in finance, do CFA. Do CFA, I will be definitely supporting you. Do CFA. So if I can complete level 3 now, we can apply for the charter certificate. Then we can work in New York. So the logic is very simple. Yeah, understand the subject properly. Are you clear? So understand the subject properly. In a right way, you understand the concept. Okay. So logic is very simple. Please understand clearly. Formula means you should know the meaning behind it very clearly. Without knowing the formula and logic, don't do that. Okay. Achieve big. To achieve big like CFA, CPA, you need to have. Why I am telling CPA na? Accountancy also same. Don't just understand what is this. Understand why it came, logic behind everything. You will become a gem of a guy. When they ask a practical scenario, see, CFA type of examinations, so case-based questions will come. Means they will give the market scenario and they will ask you to analyze. Leverages also they will ask you to analyze. At that time, you should know na, why something has come. So that's what makes CFA professionals top in the list. because of the difficulty level. Obviously, it's not one of the, that is the most difficult course in the entire world when it comes to the finance field. So do that. Do difficult courses, you will become, people say na always, okay, in order to achieve bigger things, you need to do bigger things. Na? If you wanted to become very big person, you need to do bigger things, not small things. Na? So therefore, achieve big, think big, dream big, but don't stay in the dreams. Do your work to achieve that, such that understand the concepts clearly. So many times shouting. Direct taxes, when you learn income tax, learn the Bear Act, learn from the Bear Act, learn from the Bear. Hundreds of problems you will do. Why? Yeah, for what you will be useful. Outside, if you go, if they ask some provision on appeals in income tax or something like that, you will become a big zero. You are thinking in a short term, exam is there, I need to pass. Yes, examination passing is the most important thing. Undoubtedly, is the most important thing. Beyond that, there is another thing that is very, very important. You should become a complete person. That happens only when you learn it in a right way. Reason shall I tell you why? When you will learn, okay, when you will learn when you are a student. After completing CA Inter, you can't come back and read CA Inter syllabus in life again. After completing CA Final, again in life, you can never come back and read CA Final curriculum. Until in life, you are going to read that one time. That one time also, if you put a compromise in learning process, then what grade you will achieve in life? Did you understand what I said? Out of a friendly affection, I always give advice to tell that do big things. If you wanted to do something great to your parents, don't do chiller courses, small things. Yeah, give big one, break the elephant. Are you understanding or not? Directly hit the elephant. Don't hit small fox, wolf, hyena. Don't sit with them. How it should be, if you do something, it should create a sensation in the market. So do bigger things, learn in a bigger way. Okay, don't just learn in a small way. Yeah? Think big, think very big, go beyond the boundaries and think. We should understand in such a way that no other person should understand in that way, in a positive way. In that way, you have to read books. In that way, you need to learn things. So when you are reading income tax, learn it in a right way. Why it came? Recently, when I recorded my DT lectures, regular, not fast track, regular. Basics of income tax, I recorded 61 hours totally. 61 hours. Basics of income tax. Why? Sir, Income Tax Act is a long history. How much long history? It has a history of India. Okay, it has history of India. Two acts in India have history of India itself. One Companies Act, second one is income tax. Those two things, whenever I read, goosebumps when I tell something about those two acts. Reason is clear, yeah. British came into India with East India Company. So company has a long history of 300 years. Okay. When they came to India, they imposed taxes on people in India. Therefore, income tax concept is also there from the British age. Tax collection is there even before British in India. Chanakya's time, Cholas, Pandya's time, in our south part of India, there is a concept of taxation collection. That means this tax collection concept, this company concept, these are all very old concepts. How much old? Company from Dutch companies, 600, 700 years back we can go. Tax collection, thousands of years back, India tax collection concept is there. What lesson you should tell to the student? Understood? So the student should first understand, yes, this is income tax. This is why Income Tax Act came. Income tax law, what is income? Income definition itself, I have taken 3 hours class. Definition, section 2, class 24, subclass number 1 to subclass number 18. All the 18 clauses you should understand first. Then you will become a complete student. Or else you will qualify CA Inter undoubtedly. And you should qualify irrespective of whatever happened. I also fervently hope that. But if you don't learn all these things, you will go to final. Final, anyway, you won't learn basics. Directly, you will go with assessment procedures. For namesake, you will take one question bank, you will take one exam oriented, you will prepare, you will pass. After that, bare act if you open, sweat will come because you don't understand anything. That time you will really feel very bad. So many people we are seeing every day, they are going to big companies, they are working there because of mental pressure. Some are suicide, some are going into depression, some are feeling that why I qualified CA, some are feeling that why I am working with this employer for that 1.5 lakh, 2 lakh rupee for morning till evening. Do you understand that? See, I will take class if I want. I will not take class if I don't want. I will go to my office if I want. I will not go to my office if I don't want. Peaceful life, na? And moreover, I am doing what I sincerely love to do. This is what I love to do, na? What is more in life I want? I wanted to educate people on finance. I want to educate people on law. I wanted to educate people on taxation. I love to do that. I am doing it. I love to do my practice. I will do that. So, have positivity in mind. Have your self-generated skill. That will come only if you learn the concept in a right way. Okay, don't think that I am giving some class to you. Yes, take it as a class from out of elderly affection I am giving you. So if you don't change now, when you will change? It will take another 10 years. After that you will work under someone. You should not work under someone. Don't go down. Did you understand the point or not? Don't work under someone. You work for you. You work for your family. Understood the point? So, point is very clear. Okay. Learn in a right way. This is the last chance for you to learn. Understood? The last chance, yeah, in your life, a last chance. When you will learn leverages, once you qualify CA enter. Once you qualify CA enter, is last. Is first, is last. In a life, there is no concept called as leverages. Leverages will be there. What you will learn? Leverage, 3 leverages, operating, financial, combined. Over. Done. Problem. Question and answer formula. Where is the chance to learn? Over. That's all. Your life is gone. Learn properly. Choose your career properly. Okay? Wildfire. Not normal fire. Wildfire. So have that attitude. Don't work under someone. So have that attitude. In a positive way. You should work for you, na? Siri. Now see here. Operating leverage, percentage change in EBIT divided by percentage change in sales. Why it came like that? Sales is influencing EBIT. Just now we saw example, na? Only one item changed in top line, sales. That's it. Variable costing, contribution change. Fixed cost anyway will be same. Overall EBIT is changing. Correct? So from this, what you have to understand? From this, the logic that you have to catch is top line la one thing changes, na bottom line la everything will change except a few things. That is a fixed cost here, interest cost here. These two are both heroes as well as the villains. Listen, sales increased, same fixed cost. Fixed cost is an advantage now. Sales decrease, same fixed cost. Fixed cost is a villain now. So fixed cost is a hero na villain na? Fixed cost is a both hero as well as a villain. Okay. Fixed cost is both hero as well as a villain in the story. Understood the point or not? See, in some suspense thriller movies, what will happen? They will show one person. He will be doing good. Same person will also do bad. Okay. We don't know whether he is a hero or a villain. At the end, we will know how that person is not a hero and villain. Villain is another person. Same. Who is the villain? Not fixed cost. Sales is the villain. We think that fixed cost is a villain or a hero. Asal, why fixed cost is becoming a villain or a hero? Because sales is changing. See, I will tell this way. Sales reduced. Correct? Sales reduced. Sales reduced from what to what? 100 to 90. And the fall is how much? 10%. EBIT changed from 30 rupees to 20 rupees. 26 rupees. So, 26 minus 30 divided by 30 into 100. How much? 13%, 13.33%. Sales change reduced by 10. EBIT reduced by 13%. Are you understanding the point? Very good, very good. One person has given a great reference. Fixed cost is like Prakash Raj in Rangasthala movie. There is one Telugu movie called as Rangasala. In that, finally we will know that he is the villain. So, point is, try to understand clearly. 100 becomes 90, 10% reduction. But EBIT from 30 became 26. 13.33% reduction is there. Yeah. If I fall by 10, you should also fall by 10. Na? Why you are falling by 13.33? Because of fixed cost. Now fixed cost is looking like a villain. Looking like a villain. Now, sales increased. It became 110. Okay, it became 110. 60 becomes 66. 60 become 66. 110 minus 66. 44. Fixed cost will be same, na? It will become 34. Now 30 became 34. 30 became 34. So 34 minus 30 whole divided by 30 into 100. Now increase by 13.33. Sales increase by 10. EBIT increase by 13.33. Yeah. Means what? If I change by 10, you should also change by 10. Na? Now I increase by 13.33. My EBIT is magnified now. Now fixed cost is a hero. So we are seeing fixed cost either as a villain or as a hero. Fixed cost be like meme content type. Fixed cost be like, okay, what did I do here? I am not at all changing. Na? I am non-responsive item in the entire income statement. Okay, I am a non-responsive item in the entire income statement. How come I will become a villain or a hero? Hero means he will have some quality. Villain means villain also have some quality. Okay, fixed cost is saying that I became a villain not because of me. I became a villain because of that another big villain. Who is that big villain? A villain is sales. Shall I tell you one example? This year 100 is the sales year. Next year also sales is 100. Variable cost 60. Contribution 40. Fixed cost 10. EBIT will be 30. Change or not change the EBIT? Not change. Then how can you tell that fixed cost is a villain? Yeah. You are changing and you are putting blame on fixed cost. Enna pakshapatham. Nyayama patha, this is not my mistake. Na? Hey, answer, yeah. How come you can put blame on me? Fixed cost be like. So, fixed costs always don't become hero villain by themselves. Fixed costs become villain, fixed costs become hero because of the top line items change. See, EBIT sales do not change, EBIT do not change, EBIT don't change, EBIT don't change, EBIT don't change, EAT don't change, EAT don't change, EPS don't change. Who is changing? Sales is changing EBIT. EBIT changes all the remaining items. So EBT says I am changing because EBIT changing. EAT says I am changing because EBT changing. EPS says that I am changing because EAT changing. Why you are throwing blame on me? Are you understanding the point or not? So always remember, fixed costs are neutral items, but those neutral items turns into villain or into hero dependent on the movement of the top line items above them. So at the end of the story, I will tell this way. This is operating leverage. There is another leverage called as a financial leverage. Financial leverage means EPS is changing or not changing? EPS changing or not changing? Changing. So that influenced percentage change in EPS. For a percentage change in, see here, EAT is there, EBT is there. Above EPS, EAT is there, EBT is there. See here, I will show you. You can understand. See, hey, where is this? Financial leverage, Day Institute. See, financial leverage. Percentage change in EPS by percentage change in EBIT. Okay, percentage change in EPS by percentage change in EBIT. Understood? See, percentage change. Percentage change in EPS. This is the point block. Okay, what should come in this? Percentage change in EAT, EBT, EBIT. See, how to understand what should be taken? Sales influences EBIT. EBIT influences EBT. Why? See, if EBIT itself is not changing, EBT will not change. EBT don't change, EAT don't change. EAT don't change, EPS don't change. But now EPS is changing. Why EPS is changing? Why EPS is changing? Because EBIT is changing. EBIT do not change mean none of these items will change. Na? Last year 30 EBIT, now also 30 EBIT. Interest won't change, tax won't change, number of shares won't change, EPS also will not change. That's why they take in the denominator percentage change in EPS divided by percentage change in EBIT. Everybody answer understood the influencer and influenced concept or not? Everyone. Okay. So, two formula we already understood. Operating leverage, percentage change in EBIT by percentage change in sales into financial leverage, percentage change in EPS divided by percentage change in EBIT. This will cancel. Combined leverage equal to percentage change in EPS by percentage change in sales. Percentage change in sales. Ante how the combined leverage concept is affecting? Combined leverage directly matches two people. Sales with the equity shareholders directly. Sales with the equity shareholders. Equity shareholders will expect EPS. Equity shareholders will expect EPS. And what is changing? EPS is changing. Because of what? Because of the change in sales amount. Because of the change in sales amount, EPS is changing. Understood? First of all, everyone, see this. I will show you a document. See this document first. Take 2 minutes. Have you read all the formula, everyone? Okay. So see here, there are actually two different kinds of formula here. Okay. One, contribution by EBIT, EBIT by EBT, also called as EBIT minus interest. Last one is combination, easy. So first we completed the difficult ones. Percentage change formulas we completed and understood the logic. Influencer comes in denominator, influenced will come in numerator. What influences what, if you understand, the formula can be easily framed. Next one, sir, why this is used, or when this is used, or when this is used. See, if they give you data related to 1 year, use this. If they give you data relating to 2 years, this you have to use. Next, they will give data relating to percentage directly in the question. First you will calculate percentage. After that you should use this formula to apply. Sir, I didn't understand. For that we need to do some problems to understand the real life application of these concepts. Okay. See, sixth formula. Contribution by EBIT, EBIT by EBT, multiply EBI contribution by EBT. Clarity. Okay. Some formula before we go on into the next one. Income statement. See, from here, next to 5 minutes, listen carefully. Fastly, we will go into the concept and complete. Sale price, variable cost, fixed cost, sales. Given a prepare income statement, PV ratio, break even point, margin of safety, profit. Okay. First income statement, step number 1, we have done. Okay. 60,000 variable cost, contribution, fixed cost, profit. So we calculated the income statement over. Okay. Second one, PV ratio, contribution by sales. You can do it in two ways. CPU by SPU, contribution by sale. Per unit you can do, total also you can do. So per unit if you do, contribution per unit 4, sale price is 10, PV ratio 40%. Contribution is 24,000, sales is 60,000, again the percentage is 40%. So PV ratio of 40% means when sales is 100, contribution is 40. Okay. So now listen carefully. Sir, I don't want to go deep into this. You know, leverages normally introduction will take 3 to 4 hours. I'm going to complete that in 30 minutes. Means fastly I will go into the main idea behind it. So PV ratio formula, CPU by SPU, total contribution by sales. Done. Next one. Third bit. Break even point. Sir, break even point is very simple here. See here. What is the contribution? 24,000. Okay. What is the contribution here? 24,000. How many units you are selling? 6,000 units. How many? 6,000 units. Price 4 rupees contribution. So my question is very, very simple. Listen carefully. First prepare an income statement. 60,000, 36,000, 24,000 is contribution. Break even point means what? Break even point means this should become 0. This should become how much? 0. Now my question is, to become 0, what should be contribution? Contribution should also be 10,000. Should also be how much? 10,000. Because fixed cost is 10,000. Okay. To have a contribution 10,000, how many units I have to sell at 4 rupees per each? 4 rupees into dash makes 10,000, 2,500. So 2,500 is called as a break-even units. 2,000 is called as a break-even units. And in a simple formula, how can I tell? I can express this as fixed cost divided by contribution per unit. 10,000 divided by 4. 2,500 units. 2,500 units is called as a break-even units. Let us put the numbers there. Take calculator. 2,500 into 10. 25,000. Okay. 25,000. 2,500 into 6. 15,000. 10,000. Fixed cost 10,000. Profit is 0. From this, what is the moral of the story? Moral of the story is very simple. What they wanted to tell, if the sales is 25,000, then your profit will become 0. How to calculate? Nothing. Very, very easy. Fixed cost divided by contribution per unit. Okay, contribution per unit. You will get the number of units which you need to sell to have exact 0 profit, 0 loss. Okay, done. See, that's why fixed cost divided by contribution per unit. Like this, we can do one calculation. No, sir, is there any other alternative? Total you can do. In value, you can tell, not in units. Break-even units already calculated. Na? Into selling price, you tell 25,000. 25,000. Or you can also tell as fixed cost divided by PV ratio. Fixed cost divided by PV ratio. What is the PV ratio? Already we calculated 40%. Fixed cost 10,000 divided by 0.4, it will become 25,000. You can use any of these three formulae. Beyond this, I am not going to discuss in revision classes. Main class I will also tell this derivation, how these concepts came. But this is not the time to learn all those. Did you understand in principle all the points clearly up to here? Everyone in the class, reply. Next. So, break-even formula. Fixed cost divided by contribution per unit. Break-even units into sale price. Fixed cost divided by PV ratio. Anything you can use and calculate break-even. Next. Margin of safety. Next one is what? Margin of safety is nothing but profit above break-even. Profit above break-even. 2,500 units. 2,500 units out of 6,000 is break-even, means balance 3,500 is the margin of safety. Okay. Margin of safety, 5 types you can calculate. Actual sales minus break-even sales. 6,000 minus 4,000, 3,500. Just now I told. See, margin of, break-even concentrates on fixed cost. Margin of safety concentrates on the profit area. What is the profit? What is the profit? 14,000. See, fixed cost by CPU will give you break-even. Profit by CPU will give you margin of safety. Okay, this is the one. In value, actual sales value, 60,000 minus 25,000, 35,000. Next, margin of safety units into sale price, 35,000. Or there what you use, fixed cost by PV ratio. Here profit by PV ratio, 35,000. Everybody answer. Understood break even is, margin of safety easily, yeah. Don't waste time, yeah. We have to fastly complete. Understood? See the 5 formula properly. We'll go into the concept. See the 5 formula properly. All the 5. Okay, next. So let us do some questions now. Finally, I think 5 points are there now. Last one is a profit. Balance is a profit calculation that you need not discuss. One very important formula is there. Yeah. Around 6-7 times in exam that question came. What is that? Operating leverage using margin of safety. Operating leverage using margin of safety. Sir, how sir? Operating leverage, margin of safety both are same. Hey, operating leverage is what and what? Matching sales with the EBIT is the operating leverage. Correct? Margin of safety is what? Matching sales with the EBIT. Hey, percentage change in EBIT by percentage change in sales is what? Operating leverage. Okay, margin of safety is what? Matching sales with profit. Profit is nothing but EBIT, na? Therefore, margin of safety is another way of telling operating leverage. Okay, operating leverage is in percentage, margin of safety is in amount. Therefore, they will do 1 by such that it will get converted into percentage. Okay, so that's it. Margin of safety or operating leverage equal to 1 by margin of safety. Margin of safety equal to 1 by operating leverage. Anything. KE equal to 1 by PE, PE equal to 1 by KE. Like that, OL equal to 1 by MYS, MYS equal to 1 by OL. Are you all understanding the point or not, everyone? Everybody, answer. Understood. We'll start doing the problems if you say yes, sir. Okay. Yeah. Those are the things. This is all classroom explanation. Pages and pages of notes we will write now. Summary of risk, etc. Let us do some quality questions. Everyone, let us start doing. Let's do illustration number 3. Let's see illustration number 3. See, sales 100 rupee per unit, 24 lakh, variable cost 50%, fixed cost 10 lakh. It has borrowed 10 lakh at the rate of 10%, equity share capital rupees 10 lakhs of 100 rupee each, consider tax at 50%. Calculate operating leverage, financial leverage, combined leverage, return on investment. If sales increase by 6 lakh, what will be the new EBIT? Okay. What will be the new EBIT? Read the question. Once you say yes that you have read the question, we'll start with the solution. Okay. Done. So let us start doing this question. Sales rupees 100 per unit, 24 lakh, variable cost 50%. See, let us do together. Sales equal to 24 lakhs. Okay, sales 24 lakh. Variable cost will be 12 lakh. Contribution 12 lakh. Fixed cost 10 lakh. EBIT 2 lakh. Okay, minus interest 10 lakh borrowed at 10%, 1 lakh. Okay, next EBT 1 lakh, tax 50,000, EAT 50,000, number of shares 10,000. How I got 10,000? 10 lakh divided by 100 will give you 10,000. EPS 5 rupee. Everybody answer. Did you all understand up to here the calculation? How EPS is 5 rupee in this case? Everyone be present in live and answer properly. Did you understand how the answer came as 5? Okay, so EPS is 5. Done. So now we need to calculate operating leverage. Operating leverage is what? 1 year data is only there. So contribution by EBIT. Contribution by EBIT 6 times, not 6%. Financial leverage EBIT by EBT 2 lakh divided by 1 lakh 2 times. Combined leverage, this into this 6 into 12. How many times? 12 times. Return on investment. Return on investment. See, I made investment in 2 parts. 10 lakh equity investment, 10 lakh debt investment. Total investment is how much? 20 lakh. Return divided by total investment. Return means what? Total available funds in the company is the return. Return on investment. See, what is investment I kept? 20,000. See, listen carefully to the point. They did not ask a return on equity. They asked a return on investment. Who invested in the funds of the company? 2 people invested in the funds of the company. Number 1, equity. Number 2, debt. Both are in the denominator. Numerator, both of them, for both of them, what is the amount available? EBITA, EBTA, EATA. For both of them put together, see, EAT is belonging only to equity. Okay, EBT is the amount belonging to both both equity shareholders as well as the debt holders. Correct or not, everyone? So we need to take in the numerator EBIT, EAT. EBIT is also wrong answer because in EBIT taxation element is there that we need to take out. So EBIT is how much? 2 lakhs. 2 lakhs into 50% you remove. Okay, 1 lakh. 5% is the return on investment. See, 5 rupee, 5 rupee. Okay. Next, 6 to 12. 6 to 12, 5%. See, that's how answers has to be done. Okay. Next, after that, if sales increase by 6 lakh, what will be the new EBIT? See, they are asking a question saying that sales increase, EBIT means they are asking influence of EBIT because of sales changes. Means they are asking about operating leverage, combined leverage, financial leverage, operating leverage. How much is operating leverage? 6 times. How much is operating leverage? 6 times. See, I will give you an example. Percentage change in EBIT because of percentage change in sales is called as what? Operating leverage. Is called as what? Operating leverage. Okay. Now what is the sale? 24 lakh. Now what is the sales? 24 lakh. 6 lakh increase. What is the sale? 30 lakhs. What is the percentage change in sales? 30 lakh plus 24 divided by 24 into 100. 25%. Okay. Okay. Operating leverage 6 times means what? EBIT increases by 25 times. Okay. Sorry. EBIT changes by 25%, or simply to tell, percentage change in sales is 25%. Correct? EBIT will change 6 times of that 25. Means how much it will change? 25 into 6, 150% there will be a change. I repeat one more time for those who did not understand. See, they said sales increased by 6 lakh. Already what is the sales? 24 lakh. Increase by 6 lakhs means it will become how much? 30 lakh. What is the percentage change in sales? 25%. For 1% change in sales, okay, EBIT will change by 6%. If there is a 25% change in sales, EBIT changes by how much percent? Increases by 150%. What is the existing EBIT? What is the existing EBIT? 2 lakh. 2 lakh increased by 150%. 3 lakh. 3 lakh is not the new EBIT. Increase will be 3 lakh. Already 2 lakhs is there. 3 lakh will increase. What is the new EBIT? 5 lakh. Perfect. That's how the calculation was made. Everybody answer understood the point clearly or not? Everyone? One question, so we have completed entire leverages area. One good question if you do practice. Leverages chapter, nothing is required here. Do study material illustrations, do study material book back questions. That's all. Okay, concept I explained. One sample question covering all kinds of leverages also we completed. Did you all get the clarity on leverages concept or not, everyone? Okay. I will give you one assignment question. You will do. Okay. Illustration 5. Max 8 minutes time. Now it is 11:34. 11:42. More time I have given. Do it properly. Have you completed, everyone? 4 minutes already over. You should have completed for A Limited. By this time, you should have completed for A Limited. Both are completed also. Super. Very nice. So let us see the answers now. You please check the answers. How to answer, how to present the answer is more important. Okay, see here. First, sales 3,75,000, 3,75,000 and 8 lakh. A Limited and B Limited. See, first one I will tell you how to do. Point number one, you can see the question first. He is first asking you find out EBIT sales fixed cost. First, let us see the three questions. Variable cost ratio given, interest is given. Okay, interest is given 20,000. Sales 3,75,000, variable cost like this they have given. See, step number two. First, I am filling the numbers. Calculation of sales EBIT. Calculation of EBIT for A Limited. Already in the question they have given financial leverage of 3 and 2 respectively. So EBIT by EBT equal to 3. EBT can be written as EBIT into 1 minus T is equal to 3. Interest is given. For A Limited. We have calculated EBIT as 30,000. Here EBIT as 2 lakh. So 30,000 and 2 lakh is the first missing figure calculation. Okay. Already what they have given, interest they have given. So EBIT is there, interest is there. EBT we can calculate 10,000 and 1 lakh. Tax rate they have given in the question 30 and 30. So we deducted, we got EAT. So from here to here everything is filled with it. Next, after that, next stage. Calculation of sales. Calculation of sales. We have EBIT, we have operating leverage. Contribution we can calculate. Contribution became 1,50,000 and 4 lakh. Contribution is there means sales is nothing but the balancing figure. So 3,75,000 and 8 lakh. 25 and 8 lakh. That's it. It's a missing figures type of calculation question. Okay. But listen carefully. I will show you an example. Okay. See here. Okay. High operating leverage. High operating leverage. Or I will write this way. Four situations can happen. Okay. High operating leverage, high financial leverage, and a great risk of operations. Means sales will change like anything. 1 year it will be 10 crore, another year it will be 1 lakh. Like that it will change. Along with that, fixed costs are huge amount of fixed costs. This will be extremely, this is called as very risky probability. This is a very risky proposition. Okay, very risky proposition and very risky proportions that they are investing. Next, high operating leverage, low financial leverage, risky. Sir, business risk means sales risk. What we discuss, sales is the source of entire risk. Okay, operating leverage high means risk of sales is high. Sales change is very high. Therefore, whenever high operating leverage is there, risky. Low operating leverage and high financial leverage, this is the best proportion. Means when sales are growing like anything, even you can borrow amounts and you can put the amount and you can get the financial leverage advantage. Means you can borrow at a lower cost and get the sales at a higher rate of return. You can enjoy the gains like anything. Okay. Next one, low operating leverage and low financial leverage. This is not risky, but this is low return category. Great returns also don't come because you are not taking any risk. No operating leverage means no business risk. Low financial leverage is low finance risk. When you take low risk, you will get low return. Okay. Always this is a best combination. Okay. Let us see now. Our companies A, B belongs to which category? See. 4 things I said now: high operating, high financing, high operating, low financing, low operating, high financing. Okay, low operating, low financing. These are the 4 situations that can occur. Now, let us see. A Limited, operating leverage 5, financial leverage 3. Sorry, financial leverage 3, operating leverage 5. Okay, financial leverage 3. Very good. First category it is falling. Next, B Limited falls under low financial leverage and low operating leverage. Final category it is falling. Okay, final category it is falling. Low operating leverage and low financial leverage, almost equal amount they are taking. Okay, this is low risky, low return. This is highly risky. See the conclusion. Company B is better than company A. Answer over. That's what I also told. Na? Okay. See, company capacity B, it is having more interest payment concept. Okay. That's it. Sir, everybody understood the whole idea of leverages chapter summary and 2 important questions we have done. Everyone got the full confidence on the chapter or not? Everyone. Everyone understood? Yeah. So this is what I wanted to discuss in the leverages. Sir, leverages chapter nothing but practice. Now after the lecture is completed, do you know what you have to do? Open leverages chapter. See, when fire is there, you should continue with the heat. Heat of the moment will not come whenever you want. What you have to do, once the video is completed, live is over. Okay. Once the live is completed, because at 12:45 again I have another class. That's why. So once I stop the live, next work what you have to do, dividends chapter, leverages chapter, complete the problem. 6, today's 3 hours or 3.5 hours spending is equal to 12 marks. Do all questions you have. Okay. Do all questions you have. Tomorrow morning again we will have the session at the same time. At that time what you have to do, when you have the session at the same time, by that time you should tell me that you completed dividends and leverages, such that another 2 chapters I will take. Okay, another 2 chapters. Whatever pending part today, working capital I did not complete. That will take 1.5 hours. That working capital I will complete. After working capital I will go into possible I will go to capital budgeting. Working capital budgeting I will take. Such that good amount of portion will be completed, good amount of marks also will get completed. Please, heat of the moment learning you have to do, or else you cannot do later. Later becomes always a later. Okay. So this is the point I wanted to tell. Everyone, you should reply me one answer. Are you all satisfied with the today's live session of completing 2 very important 6 marks area? Everyone, honest reply. Do you all understand the concept? Did you learn something new? Did you learn something confidently? And are you confident now to do the 2 chapters? Okay, yes. So once the video I will upload now. Okay, I will upload the video also now. So after uploading the video, if you have any doubts, you can go back and you can refer that. But please listen carefully, attend live and complete it. That's the best way to do. Because see, in 3 hours you can complete 2 chapters. Normally your mind will go to 1,000 places. Okay, so do these 2 chapters first. 12 marks will be over. Okay, illustrations book back more than sufficient. You will get confidence first. Do that properly. Okay, so tomorrow's session we will again meet. We'll complete another 2 areas. First we will take working capital estimates, then we will be going into the concept called as capital budgeting. Bonus, buyback, all those I will upload. And the only thing is, more student reach should be there. Means share it to your friends, wherever, whoever are in the need. Ongoing batches of FM anywhere they may study. Ongoing batches, ask them to listen. And second thing, the algorithm of the video has to promote in such a way. You need to either put a like on that or share it such that it will reach more people. That's the only intent, such that more people will get benefited. Rather than mugging up FM, they will understand what really FM has to be doing with. Okay. Okay. Illustration 4, someone is asking. Tomorrow I will get it done. Definitely. Okay. Tomorrow I will do. Okay then. Thank you very much. Meet you again in the tomorrow morning. Prepare. Okay, prepare. Do the problems. Complete dividends and leverages. Today you have to complete 12 marks. And 50 marks or 12 marks should be completed with this live session. As the next class again another 6 and 8 marks. 14 marks you have to complete. 25 marks if you can do through live. What more you need to do? Yeah, 25 marks will be covered. Okay. Thank you very much. Meet you again in the next class.